markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
To the FOMC's December meeting, the data of the past few weeks have made me more comfortable considering stepping down to a 50 basis point hike.
The gentleman from St. Louis, Christopher Waller, with huge respect among economics professionals. He is a Federal Reserve governor as well. Speaking yesterday in a slow day for Fed Speak, and Lisa, to review here, there's 14 speakers today.
Literally, day in the life of a Fed
Maybe member. Jeremy Hunt will want to give a speech on Fed policy when he's done with the austerity speech.
I actually think they would be interested in a sort of Fed reality TV show, because it seems like we get one every day these days.
It is. It's a lot of speak, and someone watching that and doing it for decades. Liz Ann Saunders joins us now, Chief Investment Strategist at Charles Schwab. And I must say, within the talk of inversion and all that, what about the stock market? What about the rally? Liz Ann, I saw somebody the other day looking at SPX or whatever, up 18%, up 17%, and trying to measure the beginning of a bull market. You're too young to remember 75 or 82. I remember. How do you figure out a bull market, Liz Ann Saunders? When do you say bull market?
So I actually think that the retest and move down below the mid-June lows that we got in October looked healthier under the surface. You had a better sentiment underpinning. And in fact, at least as of Wednesday last week, you had finally seen behavioral measures of sentiment like the put-call ratio get to the same amount of washout, pessimism, puke phase, whatever you want to call it, as the attitudinal measures. And then you had a positive divergence develop at that October low, where under the surface, the breadth actually was a bit improved relative to what we saw in June. So I'd say you can check some boxes. However, I think from a more macro perspective, what's still ahead of us is more downward revisions to forward earnings, more stability both in yields and the dollar. And I think we need to see stability in housing and PMIs. So I don't think you can check those boxes yet, even if you've got some better sentiment and technical underpinnings.
Liz Ann Saunders, these are unusual times, to say the least. And Lisa and I want to talk to you on your research note, where you link in the upset in Bitcoin over to traditional equity investment. Are you suggesting that the damage in Bitcoin from 20,000 to 16,000, the uproar, the scandal, the innuendo can actually affect someone's 401k?
Well, it depends on what they hold. Many, certainly our investors probably don't hold a lot of crypto within their 401k, but it can sit in other parts of their overall net worth. And anybody that's been a holder of anything crypto related has suffered. And when you saw the collapse of FTX, you did get a sense of some margin calls kicking in, which forces selling in areas where there is more liquidity. I think that was one of the reasons why you saw the spike in the put call ratio. I think there might have been just some quick hedging or protection put on in the options market that may have been tied to crypto. But trying to figure out from here the ripple effects, the counterparty risk. I heard on your network an interview with somebody from the CFTC that his job is to focus on the crypto world, which is not what I do. And her response was the same: is we just don't know yet. I'm surprised there hasn't been more weakness in something like Bitcoin, but I don't think this story has yet been fully told. I think there are still chapters left in this crypto story.
There's a larger question, Lizanne, that has to do with, are we there yet? Have the bubbles popped, right? We talk about Meta, for example, shares down nearly 70% year to date. We talk about some of the big tech names and the small tech names that have gotten eviscerated. How do we know if the bubble has popped?
Well, I think there have been many of what I've been calling micro bubbles that have, in some cases, popped in spectacular fashion, even beyond the 70% or so. When you go into the sphere of crypto or SPACs, non-profitable tech, heavily shorted. The problem, though, is that even if you see a bubble pop and you've got drawdowns in the 70, 80, 90+% range, that doesn't mean you might not see at least a short-term reinflation in some of those. I think that was the knee-jerk reaction on Thursday and Friday. The buying went back into some of those down the quality spectrum, prior speculation-driven areas of the market. And I think, back to is it a bottom or not? I think you want to fade any sharp rally down the quality spectrum. I don't think that's where you want to be in the environment right now. But I would say those bubbles have popped. That doesn't mean they can't, come back to life, at least for the short term, as we've seen recently.
As you talk, I think about what New York Fed President John Williams said yesterday when he talked about financial stability risks and financial risks in general, not necessarily being a driver of monetary policy. It shouldn't be a driver of monetary policy, which basically was, we're not going to cut just because you guys are seeing losses, basically. So at what point do you see this rhetoric, believe them, do not believe in any rate cuts, and just go into long duration and hide there for as long as you can?
Well, it's funny that you say that because, the market strength has brought with it looser financial conditions, which is not what the Fed wants. So not only are they distinguishing between market weakness or market volatility and financial system stability, which is the right thing to distinguish, and still trying to reinforce that there is no Fed put, they're not only not going to step in simply because the market is weak, it aids them in their quest to see tighter financial conditions. So if anything, we may be experiencing since August, when Powell first made his comments at Jackson Hole, almost a Fed call where Fed speakers, Federal Open Mouth Committee, as we jokingly call it, have to step in and push back against looser financial conditions and any narrative that is starting to brew around, a pause is imminent here. And you continually have to see them do that, because I think this narrative of now pivot to pause is one that is just not yet backed by the Fed.
Lizanne Saunders, thank you so much. Greatly appreciated today
Good to
with
see you
Charles Schwab on the equity market and the linkage there into Bitcoin as well. I'm absolutely fascinated where we are in the equity market and the shock and the silence of the cash crew and the bears. I mean, it's a really intriguing moment, and I see it day to day as we put the show together. There's just a thundering silence of the gloom crew over the move that we've seen.
Are you saying that they are humbled by the fact that we've seen a rally? Is that the way that you're
I haven't looked at it. You can do this easily on the Bloomberg, folks, and this is a one-year change. The Dow is out of correction stage, a negative 7% for 1 year, and SPX is mid-center between correction and bear market, negative 16%.
So they've clawed back some of the losses, right? But we've heard from the bears, the people who actually do think there are going to be further losses next year.
Yeah.
And they're very nuanced about it, because there is still money sloshing around. They're nuanced about it perhaps because it's their job, but also because right now is a nuanced moment. We're going to get to some weakness. We don't know what it's going to be. We don't know how long it's going to take. And in the meantime, people still have all of the money that hasn't yet been withdrawn from the financial system. How do you play that? And that's why you're hearing people talk about short-term rally, long-term something else.
Good news. Macy's is not Target. Macy's, with a first look here at their earnings out and a nice lift of the stock, up about $1 as well. Margins boost. Comp stores were better than the gloom that was out there. Macy's holding up retail. There's a Thanksgiving parade before you cut your Christmas tree. This is Bloomberg. Good morning.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This could be somewhat of a shallow recession, but more prolonged period of downturn.
The market is going to continue to heal over the next year, but you're still going to have a more volatile environment.
The coverage soft landing, maybe it will happen. Maybe we have the disinflationary forces.
It has to go all the way to 2 for the Fed to be able to truly step off the brakes and allow for a neutral policy.
We're all certainly trying to figure out when the point is correct for the Fed to slow down, when the tightening is going to slow down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Bloomberg Surveillance, an eventful day. Chancellor of the Exchequer speaking of austerity here 30 minutes ago. We move on to claims here at 8:30. I don't hear anybody, Lisa, talking about claims anymore.
Well, because
it's like
they're so
old news.
noisy. And honestly, unless we get some massive spike in claims, do they ever tell us anything? Markets don't move on this because they're not necessarily looking at them as a real sign, except for ongoing strength in the labor market, which is not a good sign for markets right now.
Ongoing strength in retail. Get it yesterday. Collapse, Target, terrible. Kohl's just out with a beat, 82 cents versus 75. Don't know how that's massage. Macy's really with a remarkable performance. And it really shows what Dana Telsey said yesterday to us. Every story matters.
Yeah, how much they've retrenched, how much they've shifted their inventories, how much they're really dealing with their real estate footprint. We'll dig into the details. We're getting some of the others as we speak. With Kohl's actually not doing as well, actually seeing their third quarter comparative sales down 7.2% versus the estimate of 6.8%, one by one, sending a motley picture of a really difficult holiday season for a lot of people who are making a lot more difficult choices.
We are must watch and must listen. I'm going to sell it to you right now. Coming up, a gentleman who's modeling out inflation moving rapidly to a better spot summer of next year. And later on inversion, which we're going to do right now, Ira Jersey will join us from Bloomberg Intelligence. And we're thrilled to bring you Ian Lingen of BMO Capital Markets with his true expertise in the bond market. Lisa, this is your wheelhouse. As we have spoke this morning, we've gone from -63 to -65 basis points of inversion. every pro is riveted to this statistic. Why?
Because it means usually within 12 months after that, you get some sort of recession. And right now, a lot of economists are just pricing in about a 60%.
So this is not the Fed.
Right. This is just basically the world, the market, right? Deciding, okay, what do we see going forward? Right now, it is more profitable to invest in very short-term instruments because that's how much this government has to pay you to lend to them over the short term. Longer term, they've got confidence things will right itself. This is unusual and it portends pain.
With the moving parts of this in the dynamic, the heart of the matter is longer maturity bonds are bid up, price up, and their yield comes in, and that forces the inversion, right?
Exactly, which is the reason why the results that we're getting are so confusing, right? Macy's doing really well, shares popping 5%. We've got Kohl's coming out doing badly, shares plunging more than 4%.
Withdrawing guidance.
Right, and basically the bifurcated pictures are hard to get a big sense of where are we now and where are we heading? What is the correct forward look when you've got execution thrown into the mix and consolidation among the strongest players?
Sterling not moving much off the Chancellor of the Exchequer's speech on the autumnal statement, I should say, on what they're going to do about austerity and high inflation in England. We'll have to watch that 118.67 on sterling. Futures deteriorate -24. Dow futures -190. The VIX doesn't give me much, 24.56. Oil not part of the game today. Javier Blas has been on fire writing about hydrocarbons.
Yeah, he really has. And how much people are worried about diesel. And we've seen the White House suddenly assembling some sort of meeting on diesel as inventories go down and prices still are around record highs. What I'm listening to today is really the Fed speak, because we're getting a ton of it. We're getting James Bullard, Michelle Bowman, Loretta Mester, Philip Jefferson, Neil Kashkari, all speaking today. And then later on this evening, there's an event with Charlie Evans to celebrate his retirement. And we're going to hear from Fed Chair Jay Powell, John Williams of the New York Fed, Mary Daly of San Francisco, but they're not going to be giving really central banking policy statements. That said, the message has been clear. They see downturns. They see problems in the economy. They need to see that because they really have a focus on inflation, and they're willing to raise rates. Mary Daly yesterday saying between 4.75% and 5.25%. That is a terminal rate she thinks is reasonable, and they plan to hold it there. Today, the economic data, how quickly is this making its way into the economy? 8:30 a.m. we get October housing starts and building permits.
The housing data is grim, just as a general statement.
It's grim, and it's changing at a rapid speed that isn't necessarily going to filter into some of the inflation data for some time. But in the meantime, people are feeling it in real time. When those sales are not getting done, people are not moving, there is no inventory, and when people buy, they cannot afford to buy.
And Jason Furman of Harvard with the observation of the last 24 hours that when you look at current rents, what's called spot rents, the actual inflation statistics are coming down, disinflating much more rapidly.
Yeah, and at 10 a.m. we do get some of those October sales figures, and we'll get some sense. And we've been talking about this, the earnings that have been coming out, and we did get from Macy's and Kohl's, and it is a tale of two different stores. Macy's doing really well with those shares popping more than 7% in the pre-market trading, and Kohl's plunging more than 6%.
Boy, does that beautifully explain the divergence?
It's just two different stories of managing two distinct customer bases, right? I mean, who's Macy's targeting versus who's Kohl's targeting, and how that is really pulling apart. Kohl's typically caters to more middle income and lower income households. So how much are you going to see ongoing retrenchment among some of those stores, as really there is a consolidation among the strongest?
Again, futures -26 this morning. This is a joy. We've got some wonderful guests this morning to drive forward the conversation. Brian Levitt can do that at Invesco, global market strategist, but far more buried in his note is to model out the path to 3.2% inflation by the summer of next year. Many would say, Brian, that's a world turned upside down. What happens to our investment portfolios, equities and bonds, if we get a Levitt 3.2%?
Yeah, the reason I came up with that is just saying over the last 4 months, inflation's averaged about 0.3 a month. You continue to do that through June of 2024, you're at 3.2% inflation. And right now, it's a market that's trading on whether inflation is coming in better or worse relative to expectations. So we don't need it to be good. We need it to be better relative to expectations. As that happens, then we're likely to see that Fed pause. It's like the old Coca-Cola commercials, the pause that refreshes. And so that is what the markets are responding to. Now, maybe they get a little bit ahead of themselves in the short term, but as inflation comes down, should set the stage for a recovery.
Do I want to be widely diversified Or is it active, alpha-generating individual stock and bond selection or sector selection that will matter?
Well, it should be an environment more for active management, particularly if you look at the bigger indices. The bigger indices are still heavily concentrated in some of those larger names where those technicals on those stocks still look a bit broken. Whereas if you start to think about more of a recovery trade, more value-oriented parts of the market tend to do well, more of the cyclicals, smaller mid-capitalization. That suggests that you either want an active manager looking at that, or you may want to consider different weighting methodologies, whether that is equal weight, or which will be more value-oriented, or small, or more or lower capitalization, or whether that's even something that's dynamic that shifts across different parts of the different factors in the market throughout different cycles.
So, Brian,
different parts of the cycle.
When we look out right now and people try to get optimistic, others come in, like Axel Weber, the former chair of UBS, as he spoke at NEF and said this: I wouldn't be surprised if we have further episodes in the market where the combined rate increases and withdrawal of liquidity will lead to pockets of weaknesses in financial markets because of leveraged strategies getting cold. How much are you waiting for the next shoe to drop, as so many people are?
Yeah, I mean, look, we have volatility in these markets until there's policy clarity. People always ask me, when does volatility come to markets? Well, when there's policy uncertainty. And the challenge here is we've been dealing with policy uncertainty since the fall. And so that's a long time to be grappling with it, particularly when the economy is deteriorating. Usually you see a Fed step in and ease things. So there are some challenges. Like we haven't seen a big blowout event. We haven't seen the VIX to 40. So it's not to say that there isn't potential challenge in here. But for intermediate term investors, they're already down peak to trough 26% in the U.S. market. That's about average for a recession. And you start to think about what that recovery looks like. And that recovery is going to be driven by inflation coming down pretty rapidly, which is also what the break-even markets are suggesting.
Just quickly, Brian, does tech reassert itself when the market does recover?
Well, it's pretty rare for something that brought you into it takes you out of it as well. Now, the valuations on a lot of the tech names are looking more attractive. Typically, what happens when you move from more of a contractionary environment to a recovery, the more value-oriented parts of the market tend to outperform. And then you have to consider structurally, what rate and inflation environment are we going to end in? Are we going back to a 1.5% environment, or are we going to settle in at a 2.5% environment? If it's a 2.5% environment, then it's likely to be more the value leadership than what was a significant growth leadership in a very weak growth, low inflation environment over the last cycle.
Brian Levitt, thank you so much. With Invesco and Global Market Strategy, it's not, I want to make clear, this is not an economist modeling out 3.2% inflation to the middle of next year, but it's an idea of what's the what if that happens. And again, that's with the 1 year on. You move on and you get a new set of statistics as well. Lisa, by massive acclaim of our giant international audience, it's time now for World Cup chat. Both of us
I'm
are
girding
so
myself.
qualified.
Exactly. 2 Americans faking that they know anything about soccer,
What's
which we call football.
amazing about this, and thank you to The Athletic for getting me through this. We have to do this for John. We miss him so much. And the bottom line is they're sending 2 people from England. One has hardly played since October, and the other only played like part of the game last week. And they've convinced the coach to go to Qatar. The wonderful Calvin Phillips and the guy named Walker, who I don't even know, but that's the debates that are going on. These guys are all injured, as John says.
Yeah, well, I will say that I'm not even going to pretend, because all our reviewers who are well more educated on this are just going to sit there being like, really, John does not want to see this. No, he does not. He is rolling over in his bed right now just saying, oh.
You and I have to find an Argentinian bar.
All right, let's go.
New York to watch. That's the only way to do this. And that, folks, is your World Cup chat for the day. Stay with us if you can.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky has laid out his conditions for peace. Zelensky says only the return of territory taken by Russia will allow an end to the war. And that includes Crimea, which was annexed in 2014.
Crimea is part of Ukraine. This is not just a state within a state. It's part of our country and part of our sovereignty. Therefore, indeed, the occupation of the Crimea and Donbass will bring the end to the war.
Zelensky spoke to the Bloomberg New Economy Forum in Singapore. In the UK, Chancellor Jeremy Hunt is outlining a series of tax hikes and spending cuts aimed at getting public finances under control. The threshold at which the top tax rate is paid has been lowered. Hunt also expanded the windfall tax in the oil and gas sector. He says the moves will total $65 billion in new revenues and savings. More than a week after the elections, Republicans have won a narrow majority in the House that gives them the power to halt President Biden's agenda. Still, their slim margin is a letdown. The party has counted on decisive election results as a springboard for the 2024 presidential race. And former FTX CEO Sam Bankman-Fried is telling his side of the company's collapse, and he's doing it through a series of tweets. Bankman-Fried admitted that FTX got overconfident and careless and said he was doing his best to save the customers' cash. FTX's new management, though, said Bankman-Fried does not speak on the company's behalf. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Midget Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The top names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
Using monetary policy to mitigate financial stability vulnerabilities can lead to unfavorable outcomes for the economy. And monetary policy should not try to be the jack of all trades and a master of none.
The comment of yesterday, there is no ifs, ands, or buts about it. If you're in the game of global Wall Street, the gentleman from San Francisco and New York, John Williams there, yes, R-starred with a blistering 2 sentences. Lisa Abramowitz, there was the arch academic saying, would everybody stop dovetailing financial stability into monetary policy responsibility? He didn't mince words.
No, we cannot be a jack of all trades and a master of none. In other words, we're not going to try to solve market problems at the potential expense of not targeting inflation. Inflation is the preeminent concern, and they're going hard against that.
I can't wait to see how Loretta Mester plays off that. I have such respect for Dr. Mester at Cleveland and the mathematics of all this theory and mumbo jumbo. What are we going to hear today following on from John Williams?
Probably a similar message, because even the doves really have been pretty hard. They all agree inflation is the foremost concern. The lag times perhaps are in question, but Gita Gopinath, I keep going back to what she said at the IMF. She raised concerns about the collective causes or the collective consequence of all of the rate hikes that you're seeing around the world. But then she said that people have to stay the course because we cannot have another 1970s. They cannot fail with their mandate.
We now turn to Washington. Anne-Marie Horton mopping up the G20 meeting. She is in Bali, Indonesia. The president is home. They always come home, Anne-Marie. And he comes home to what I'm going to say with immense respect for the lady of Baltimore and then her San Francisco, Speaker Pelosi. That is front and center. It is Pelosi Thursday. There's no other way about it. Frame this for our international audience, Anne-Marie. Does Speaker Pelosi go and see the president today?
That's a great question, Tom. I'm not sure if she goes and sees him, but clearly they likely would have had a conversation with her office saying yesterday that she's going to talk and announce her future plans today. She insinuated recently in an interview with CNN that part of her decision-making on whether or not she passes on the leadership post and doesn't want to continue on that and retires is the fact that also what happened to her husband recently at the end of October when he was attacked with a hammer with someone breaking into their home. So she obviously is consulting with her family as well. But for our international audience and for the domestic audience, clearly Speaker Pelosi has been in the limelight for decades as a politician, and then, of course, really being the driver behind the Democrats in the House, the first woman to lead the chamber. And today we'll hear what she has to say. And, you know, you look at what Greg Valliere has to say, it's not just Speaker Pelosi. He's talking about a shift, a huge generational shift. Because many in the Democratic Party want to move away from the octogenarians, not just her, but Mr. Hoyer and Clyburn as well.
I was stunned. I had forgotten Steny Hoyer of Maryland is 83 years old. Is there the same tendency in the Republican Party? I believe they have a 76-year-old running for president. Again, are the Republicans looking for youth as well?
Well, I think they're looking for something different, even if it's not youth, maybe youth with individuals that are also potentially, no one has come out, but potentially vying for that top spot. It's interesting when you look at the Republican Party because on one hand, of course, we've talked about this all week, Ken Griffin, Steve Schwartzman, these individuals no longer want to back the president. You heard from Mike Pence, President Trump's former vice president, saying he thinks there are other options. And you're hearing that people want to move away. The Republicans want to move away from former President Trump, who's obviously their bearer right now, their leader. And then you look at what McCarthy is dealing with as he's set to likely become Speaker of the House. He's dealing with the fact that he needs 218 to vote for him, ironclad in January, to make sure he can get that gavel. And what he's dealing with is the fact that he also has a number of individuals on the very right of his party that he is going to have to acquiesce to make sure he gets their vote to become Speaker. So to say that Trump is long gone would not be correct. But obviously, at the very top levels of the party, they also want fresh blood.
We do now have a majority in the House, as we've been talking about all morning. 218 have been selected for the Republicans, an increase of about 8 seats. They needed 5 to get the majority. They just squeaked through, not the red wave that many people had expected. As we really parse through the results of why there was not a red wave, what's the postmortem looking like?
It's a great question. There's going to be a big postmortem, and we've talked about this recently as well, in, I think, 2 areas. One, the fact that it wasn't the red wave, more of a ripple. What did the Republicans not get out the message that they wanted, which was it was the Biden administration or the Democrats' fault for things that all of the constituents across America feel, which is higher inflation. But how are the Republicans not able to turn that message around and say our plan was better? Potentially, the fact that they were saying that they want to make some cuts to issues like Social Security and Medicare, did that not help them at the very end of the campaigning? Because the Democrats really harnessed that. The second in the postmortem is you have to take a look at deep blue New York. The Republicans were able to squeeze through because they flipped a number of Democratic seats. Just a handful, but enough in this very liberal state that mostly always goes blue. So there's, I think, 2 postmortems for both sides, the GOP and the Democrats, following this midterms.
Anne-Marie, thank you. And safe travels. Anne-Marie Horton with terrific reporting from the G20 meetings, and particularly the meeting of the president of China and the president of the United States. Lisa, you mentioned this earlier, and you really wonder what maybe it's one of the stabilities in Washington is a bipartisan effort to put China in its place. You'll have to see how that works out.
Well, and how consistent the message is when there is also a feeling of a need for one another still and talk of some sort of collaborative effort. I don't know. I was looking actually at some comments from different companies, and it's really all over the place in terms of whether they're staying in China, prioritizing it, or getting out. Certainly the banking industry still seeing that they need to have a footprint in China, as it is still the world's second biggest economy.
Let's get out front and yield right now, as we've got Ian Lincoln and Ira Jersey coming up. A 369 10-year becomes a 3.72% 10-year yield. 2-year yield, we had the 5% chat days ago, 4.37%, shows a stunning shift that we've seen in what is a nascent, I guess I'm going to call it a nascent bull market. Lisa, the real yield, we had a 160, 161. We were going, what if we get to 2%? The 10-year real yield, 1.40%. I think that's been under-discussed.
And this is the conundrum for the Fed, right? The more that people start to pile into long-term debt, the more that eases financial conditions, as you said, a lesser real yield, and sends people back to risk. So this is what they're trying to push against in rhetoric that's increasingly hawkish, even as they talk about shifting down to a 50 basis point rate hike next month.
Am I off the mark? Am I off the mark on it's a zombie roll-up 2023? I mean, the energy out there is all of a sudden money costs. There's a cost of money. There's a cost of money.
Where people are looking for that is in the private markets, because that's the area that hasn't perhaps seen the fallout and doesn't see as much ready capital ready to flood in.
Stunning. For those of you on radio, to see it on TV is stunning. The 210 spread, the inversion, negative 65 basis points. Ian Lincoln, BMO Capital Market, Ira Jersey, and Sarah Hewen next.
stability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Bloomberg Surveillance, good morning. Jonathan Farrow, Lisa Bramlett, and Tom King. Mr. Farrow on assignment this morning. Good to have him off here, and we'll see if we see him tomorrow. Futures negative 27. They deteriorate. Dow futures negative 200. Those levels under 4,000 on SPX 3942. Dow 33,300. Haven't seen much there in the last number of days. The VIX, I'm going to call it maybe 23 to 24, as Lizanne Saunders of Schwab said. It is a churn looking for Fed information. Let's get right to it right now. We're going to do London and do austerity, but first, an austere view of retail names. Lisa, with a stock report.
Well,
where do you begin?
Well, let's talk about the 2 names that reported earnings this morning, because it is such an interesting differentiation of the haves and the have-nots. Let's start with Macy's. They reported better than expected earnings. They increased their full year forecast. Those shares popping more than 8% now. And when you look through some of the results, they're managing their inventories well. And this really is one of the key points for retailers. How much stuff do they have stockpiled that they have to sell at a discount? And Macy's actually attributes some of the gains to some of their online tracking systems, right? We always talked about blockchain actually being useful for some of these companies, that it makes them able to better manage this. And inventories were only up 4% in the third quarter, which is actually really, that's amazing, right?
Yeah,
that's really notable.
That's way better than Target yesterday.
That's way better than Target, and it's the differentiation between the haves and the have-nots. For the have-nots, Kohl's withdraws full year guidance. It also lost its CEO unexpectedly and is looking at inventories that have still been incredibly high. Those shares lower by 4%. How much is this an execution story? At this point, what you decide to buy, how you decide to sell it, where you discount, how quickly you discount, whether you end up doing this. And when I talk about an execution story, it's been all year. Macy's year to date, down 24%, 25%. Kohl's down almost 40%. So the differentiation continues after earnings that confirm that.
And part of this is a broad statement, is what portion of America is in recession now? I don't like this idea we're all in it, we're not. There's a huge body of America really struggling, as represented by Kohl's.
Which is the reason why what you buy and what you decide to sell may make the difference between the winners and losers, right? I mean, Walmart gained share in the grocery business, which people are still buying. You're seeing the number of purchases come down, but the ticket items of big purchases, the actual headline figure go up because people are spending more in bulk on one item and then retrenching in other areas.
Mohammed El-Arian on Britain, on the United Kingdom as well. The United Kingdom's Office for Budget Responsibility confirms the intensification of stagflation. It is a unique austerity in the United Kingdom. And to brief us here, the ramifications for the United States as well, with Standard Chartered. Sarah Hewen is head of Europe and Americas research. Sarah, thank you so much for joining us. What is the level of austerity in the United Kingdom?
Well, it's 55 billion pounds worth over the next 5 years. So that's going to be austerity through real freeze in public sector spending and creeping tax increases. There's a big hole in public finances that needs to be filled, and the Chancellor's announced the measures that we had expected really to try to fill that gap.
I want you to talk about scale and magnitude. I think I have to remind myself of this, folks, every day. We equate U.S.-UK analysis. The nominal GDP of the United States is $23 trillion-ish. The United Kingdom is 14% is large. It's a much smaller economy. Sarah Hewen, do they have the scale, the magnitude, the degrees of freedom to solve this conundrum?
Yes, they do, but it's quite a tough ask because at the same time we're going through what looks likely to be a prolonged recession. The Independent Office for Budget Responsibility is forecasting a contraction of GDP of 1.4% next year, and then a very mild uptick in 2024 of just 1.3%. And that's at a time when we'll still have inflation way above the 2% Bank of England target. So it's a difficult backdrop in which to try to find savings and try to stabilize debt to GDP. The expectation is debt to GDP is going to continue to rise up in the high 90s as a percent until for the next few years, before then starting to edge lower.
Sarah, did you hear the Chancellor really blame the U.S. for the inflation that the UK was feeling?
Well, there was a blame on global factors for inflation and for broader problems. Clearly, there's been the invasion of Ukraine, and the impact that that's had on commodity prices has been a feature. What he glossed over was the impact that we're feeling from the weakness of sterling, which has, of course, raised import costs more than otherwise would be the case. So there's quite a focus on external problems that have caused the recession here in the UK. But not too much focus on what's self-generated.
How much do you actually see this budget as sustainable? How much they're planning to bring debt down? How quickly, given the 11.1% CPI?
It's sustainable to the extent that it had to be realistic. Markets responded very, very poorly to what was a completely unrealistic budget just a couple of months ago. And so one of the primary drivers for today's budget was to ensure that markets weren't upset. And in fact, we've seen very little movement in yields. We've seen very little movement in the pound. Sustainability, though, of course, when we're going through a recession and having had very severe public sector cuts over the past decade, that is going to be quite tough for the living in the UK.
Sarah, a headline that I'm going to say as an amateur launches back to Clement Attlee, and maybe the reason why Churchill was shown the door after World War II. The United Kingdom Office of Budget Responsibility sees record fall in household disposable income. And to see record fall, folks, that goes back to at least Henry VIII, I am. I mean, that's a huge headline of the pain that's out there right now. Do they have to de-Brexit the United Kingdom? Do they have to reverse selected Brexit policies to help jumpstart this economy?
I think that there's very little appetite at the moment in government or even outside government to reverse Brexit. And indeed, the Chancellor was doubling down on some of the removing some of the EU regulations that apparently are holding back the UK. But that's not necessarily going to be kickstarting growth anytime soon. You're right about the big collapse in real incomes. Wages are just rising way behind inflation. Savings are being squeezed. We're already seeing signs of recession. The economy contracted in the third quarter, and I think that there's worse to come. And this is at the environment where we're tightening fiscal policy and where the Bank of England is continuing to raise rates.
Lisa, then why is sterling gone 103 to 118 based on what Dr. Hewen just said?
Because there is stability for the first time, and there is some sort of policy policy predictability, and there is policy predictability globally in terms of interest rates, with central bankers raising rates pretty consistently, this tightening cycle. And we talk about the lag effect. Sarah, you talk about the crimping of household budgets. When do we know what the lag effect is of all of this tightening? How long will it take before we see peak pain and peak effect on inflation?
I think that's going to take us another few months, and we're probably looking into the second half of next year for the full effect of the Bank of England's tightening so far to really be felt in lowering inflation. And of course, in the UK, we're likely to see energy bills rising again in April, which will further slow the decline in inflation. So we're in it for the long haul. 2023 is still going to be a high inflation and recessionary environment for the UK.
Sarah Hewen, thank you so much for the brief. Just outstanding there, folks, on, as David Blanchflower says, there's Brexit, maybe there's some politics involved, and you get up to not stochastic where inflation comes up and comes down, but Lisa is just not coming down. I don't hear that model from anybody in the United Kingdom.
Yeah, and you talk you talk about Brexit, and you talk about how much the scenario has changed. And there was a story in the Financial Times about Ireland and how they bet really big on big tech, right? Because they were trying to lure in a lot of international companies with their tax policy. And now they're disproportionately struggling in the face of layoffs because of the retrenchment that you're seeing in big tech around the world. It just shows all of the myriad problems that are kind of facing all of the different nations that also have had massive structural shift.
On a Thursday, let's sell the data coming forward. And we've underplayed this today, but we do see, and Liz Ann Saunders, I think, has been great with her charts on the complete collapse of housing, collating in all the national experts. Housing starts, survey down. Building permits, survey down, month over month. Maybe it's better than the grimness last week. We'll see what the revisions are. And then, of course, we have claims, which is not housing, but one indicator there that's been actually pretty fully employed.
You pointed me to this Dallas Fed report that was put out this week on the housing
Martinez
market.
Garcia, outstanding.
It was outstanding. I can confirm.
Did I do okay?
It was great, and I appreciate you passing it along. And
I got
was
three more
reading
behind it.
Yeah, and honestly, that really highlights the level of froth that was built into the housing market by all historic measures during the pandemic. So, how do we unwind from that?
Okay.
What does that mean for household wealth?
Should we tell a dirty little secret here of surveillance? We don't actually do this research ourselves, folks. We'll steal from anyone. And to say that the ginormous institution coming out of McChesney Martin in 1951 are the regional feds with young PhDs that are eager to do brilliant work, like Dr. Martinez Garcia at the Dallas Fed. He's out of Spain. I believe he's out of Penn, and I can't remember where else. I'm sorry, the brain freezes. But there's 8 pages of brilliance by a young PhD.
And really parsing through the effect on the broader economy if you do get some sort of housing downturn and the fear of some sort of spiraling. But, this is what people keep pushing back against. There isn't the leverage in the system. There isn't the leverage in the housing market.
Housing market there at 8:30 this morning. We'll have much more on that. John Riding will weigh in as well. He's Chief Economic Advisor at Breen Capital. Coming up, Ian Lingen on curve inversion, Ira Jersey on curve inversion. Stay with us, Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Chancellor Jeremy Hunt unveiled his plan to fill a fiscal gap with tax hikes and spending cuts. The government will increase the windfall tax on oil and gas companies. It will also lower the threshold for those who pay the top 45% individual tax rate. And there will be an almost real-term standstill in spending on public services at a time when demand for them is growing. It's a power shift in Washington, although not as big as Republicans had hoped for. The GOP has won a narrow majority in the House that gives them the ability to block President Biden's agenda. House Republican leader Kevin McCarthy tweeted that Americans are ready for a new direction and Republicans are ready to deliver. Democrats had controlled the House the last 4 years. There was a surprising public confrontation at the G20 summit in Indonesia. China's President Xi Jinping accused Canada's Prime Minister Justin Trudeau of leaking details of a private meeting between the two. Xi told Trudeau the leak was inappropriate. Trudeau responded that Canadians believe in free, open, and frank dialogue. And workers at Starbucks who are seeking union contracts will stage a day-long strike today at more than 100 stores. Now, they say that management isn't bargaining in good faith. Starbucks Workers United has unionized about 260 of the chain's 9,000 corporate-run sites in the U.S. Starbucks says it will respect the workers' rights to protest lawfully. And in Europe, auto sales rose in October for the third month in a row. Still, there's concern that deteriorating economic conditions are starting to put off buyers. New car registrations climbed 14% last month. Europe's energy crisis is driving up costs and standing in the way of a more substantial recovery. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
certainly trying to figure out when the point is correct for the Fed to slow down, when the tightening is going to slow down. And it really does come back to a middle-class driven inflation at this point. The Fed ultimately needs to go very aggressively, as they have already, to just start to get a crack in the real economy.
Marvin Lowe, State Street senior global macro strategist, was piercing yesterday on the jumble that we're living right now. Again, in 45 minutes, we get claims out and then on to some important housing data. I don't know which is more important today, Lisa, claims or housing. You make the call.
Housing.
I agree.
I just made the call.
Made the call.
Yeah, there you go. I mean, we
The
haven't really
second
got anything from the
derivatives are
claims.
we've never seen the rates of change in housing we're seeing right now.
And the potential wealth effect as potentially things reverse a bit more.
Futures deteriorate. Negative 25 has become negative 36 on SPX. Call it 0.9%. There's a real weight right now to the tape. For those watching Bitcoin, Bitcoin is remarkably stable here, 16,500. In the bond market, the curve inversion, negative 66 basis points, is truly historic. Ira Jersey scheduled to be with us later. And right now, we are thrilled and honored to bring you for Global Wall Street, Ian Lingen. He's head of U.S. rate strategy at BMO Capital Markets. I called up Jersey and I said, I'm only talking to people today that have read Frank Fabozzi cover to cover. In the bond world, folks, like Lingen's world, you have a Frank Fabozzi textbook of some 900 pages that prices out hardcover at $132, and only Lingen has read the thing cover to cover as well. Is this curve inversion in Frank Fabozzi's classic text?
Frank Fabozzi was not looking for a curve inversion of this depth. I think more importantly, what Frank would have said is that this is a mispricing that needs to be rectified in the short order. We are taking the other side of that trade. We think that there's more inversion to be realized, and the most important inverted curve is Fed funds versus 10-year yields, not just 2s versus 10s.
So you're going from the vanilla spread of 2-year, 10-year out to the many different spreads you look at, and you're going from very short term out to 10. The dynamic of two different yields moving around, which pros are encyclopedic on, and frankly our audience is like, say what? Is it about focusing on the 10-year dynamic or the 2-year or the Fed funds dynamic? Which is more important?
At this stage, I would say that the 2-year yield reflects monetary policy expectations in the very short term, but the 10 and 30-year rates, that's the market simply moving on to what's next, and what's next is going to be a pretty significant economic slowdown. So the inversion is simply a tale of two different curves more than anything else.
The yield curve contraction right now presents a huge challenge for the Federal Reserve, massive, because what you're seeing is the more they lean into hawkish talk, the more people buy longer-term treasuries, which ease financial conditions. It is this really difficult situation, a paradox for the Federal Reserve. At what point do they break something? At what point do they have to break something with rate hikes in order to get the market to say, even if you have lower rates, it is not good for risk assets?
I think that ultimately what ends up happening is the Fed's watching real rates as much as anything else. Real rates remain elevated by the standard of the last decade or so, and eventually we're going to see a more significant pullback in risk assets and equities. I've personally been surprised that the S&P 500 is roughly 10% off of the lows. That also contributes to easier financial conditions. So the more quickly the market is willing to price in a pivot, the more the Fed will ultimately need to do.
At least you see that in the Bloomberg Financials Conditions Index, which was one standard deviation now and has rallied back more accommodative to negative 0.82 standard deviations.
So this really raises an issue, especially as you hear John Williams basically saying, if we break something, we're going to keep rates where they are. We're not going to lower rates. And then people in the market say, are you? We don't really believe it. So how do you view this, right, in terms of if something breaks, what does that even mean for the Fed to get some sort of response? Is the market right?
So I think that there's an argument that the Fed is going to break something and allow it to be broken for longer than it has in prior cycles. So is that the S&P 500 down 25% from here? Maybe. It's not down 50. If stocks are off 50%, the Fed is going to need to respond in one way, shape, or form. What I think is more interesting when we look at what's being priced in the market, there's an argument there's 50 basis points of rate cuts priced in for 2023. Essentially, that's what we're looking at. That's either 100% confidence of 50 or 25% confidence of 200.
But what does it mean for something to break? What are you looking for to break that would even cause a Fed response?
So a stronger dollar leads to emerging markets under strain defending their currencies. That could be a contagion issue. That's very much top of mind. But this cycle, I expect that what will ultimately break is going to be in the real economy. It'll be on the household level, and it will be spending, and we'll be faced with a traditional economic slowdown that the Fed is content to allow play out for a while.
I got 14 questions. Let me go to the Chancellor of the Exchequer, who opened his autumn statement today saying so much was international ramifications upon his beleaguered United Kingdom. Is our curve inversion a symbol of a Fed misguided that is redounding upon other nations, including Britain?
I think that the issues facing external markets are in part a function of the fact that the Fed has pushed back against becoming the de facto central bank to the world and has been focused primarily on the U.S.
Right.
And that has come at the expense of other economies.
What does this inversion mean for our banks and the financial stability John Williams wanted to ignore yesterday? What's it mean for J.P. Morgan, Bank of America, the super regionals, and smaller banks out there doing business with business?
So traditionally, an inverted yield curve is bad for the financial sector because a steep curve implies the ability to create money via carry. The reality is, though, higher rates are generally better for banks than lower rates. And so if we are generally in a higher rate environment, I think that we'll find the financial sector not responding the way it typically has to an inverted yield curve.
What are you going to do here? What's this change in strategy for the next week or so?
I think that the market is getting poised for a breakout even more inverted from here. We're looking
Well, give me scale. Come on. To a tenth of a percentage point. Where are we going?
A number?
Negative 75 basis points in 2s, 10s, path of least resistance.
So we're on the edge of Volcker inversion. We're on the edge of 78, 79, 80 inversion.
I would say we could get as deep as a negative 100 basis points by the end of the year.
What does that do to our listeners and viewers? This is, folks, 45 years. I've never heard this. What does it do to us?
I think that it really leaves us in a anxious position where we don't know how far the Fed's ultimately going to need to push things because they'll be coming out with even more hawkish rhetoric because, as Lisa points out, that will lead to a lessening of financial or easing of financial conditions.
Did he just say there's going to be extra special more Fed speak?
Oh, it's the Fed reality show. And this is what people are watching. And we all cling to every word. As much as we want to say, does it really matter if they keep talking? Well, yeah, actually, markets move up every time they do.
Our esteemed team that puts a show together every day called up Ian Lingen today and begged. Thank you so much for coming in.
Thanks for having me.
Appreciate it.
Thank you.
And we're going to continue this discussion as well. Right now, we have to shift to Bitcoin with some headlines out here. And Lisa, I'll let you translate. Katie Greifeld's not here to translate for me, so you're in charge.
So basically, FTX bankruptcy lawyers are not happy with their client. Basically, they're saying his tweeting, Bankman-Fried's tweeting, has been complicated their case and the direct messages. We can get into that in a little bit. It's really quite notable. It was a lot of expletives in those messages.
Like a rock, Bitcoin 16,500. Ian Lingen's curve inversion, negative 66 basis points. Stay with us worldwide. Bloomberg surveillance.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that You know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view. And I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Fed ultimately needs to go very aggressively to just start to get a crack in the real economy.
There needs to be additional pain felt to really bring down price pressures back in line with what the Fed is looking for.
The risk is for higher rates, I think, especially in light of an economy that's still resilient.
The thing to keep in mind is there's a lot of money on the sideline.
A year from now, we might be in a world, Lisa, where inflation is not 5 anymore or 4. Maybe it's 3.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Forget the Macy's Day Parade. It is the Fed Parade. And this is Bloomberg Surveillance. Tom Keene, Lisa Abramowitz, John Farrow off today on a well-deserved day off. We do continue. Good morning. And really, right now, I am saying, Tom, this is all about a Fed that has one message with Jim Bullard coming out. We are not yet at sufficiently restrictive levels.
Yeah, that's the Fed talk, and we'll get much more today as well. But you see it in the markets. Let's get right to the data check. As Lisa, you open SPX -1, Dow -1%, NASDAQ -1%. These are markets moving on Fed speak.
Well, this is St. Louis Fed President Jim Bullard, coming out right now saying that Fed policy is not yet at sufficiently restrictive levels. Hikes have only had limited impact so far on inflation. This is the lag effect, but that isn't going to stop them, right? Rates need to be increased further to curb inflation. And this really is the key. They are going to keep raising until they see some progress. And right now, whether it's retail sales, whether it's other economic indicators, they're not seeing it.
Yeah, 10-year yield up 6 basis points, 3.75% off 3.69% yesterday. But Lisa, to me, what is so important here is there's a crew out there saying they're beginning to see substantial tea leaves showing a lesser inflation. Jason Furman's incredibly important tweet yesterday on housing, and we get more housing data here at 8:30.
The tea leaves aren't enough. And this, to me, is what's telling. That when markets get optimistic about the tea leaves, Fed officials come out and they say, just stop it.
Well, they're
just
institutional. If Jim Bullard was a professor at Indiana University, it'd be a different Jim Bullard. These guys, including the vice chairman, have an institutional responsibility to be ex post and ultra cautious.
They don't have the luxury of being academic. They have to affect markets in real time. And this is where the gamesmanship comes into play, where they're saying we're going to go hard and go into this, and then we're going to cap the S&P level, basically. I mean, for all intents and purposes, it's essentially what they're saying. We don't want to see things rallying that have risk. And markets are saying, we don't buy it. We think that you're going to cave.
We got an incredibly important set of guests here, and we will do Bitcoin and FTX and all the rest of it here at 8:45. Katie Greifeld, I'm thrilled, has darkened the door, and we'll get her on here on real uproar within the, what do I call it, the blockchain? Is it the bit chain?
Well, it's crypto assets, you think it's fair to say.
The BitChain space. I'm already getting hate mail on this. It's working. It's not Pharaoh. I'm getting hate mail, and it's working out. Negative 41 on SPX futures, a full 1% down. Dow, negative 307. The VIX doesn't move yet, but I don't believe that number. 24.88 yield. I mentioned up 7 basis points, 3.76% on the 10-year yield. I do agree it's off of the Bullard statements. That curve inversion, thank you, Ian Lingen, for joining. Negative 66 basis points, stunning over 45 years with Global Wall Street. Truly back to the time of Volcker. Oil, we've barely mentioned this morning. Oil at 90. Oil's down a little bit, maybe some economic slowdown. Bet there, $91 on Brent crude. I don't know what to do with foreign exchange today. Currency,
bit of dollar strength.
The chancellor moves currency, moves sterling rather a little weaker, and a little bit of dollar strength. I do okay
a little
there.
bit. Yeah, you did great. But what we're seeing right now is a market that continually is surprised by the same message being sent by the Fed over and over again. Why is the market surprised? I don't understand. Let's speak to the market. Beata Kerr is going to represent the market today, co-head of investment strategies at Bernstein Private Wealth. I'm curious from your perspective, why is the market surprised that the Fed keeps getting more and more hawkish in the rhetoric?
I'm not sure that the market's surprised. I think the market's trying to find its footing. The same things that you've been quoting this morning, all investors are struggling with. It is a macro-led market. We're focused on earnings and differentiation in companies, but there's no doubt about it that inflation, like you said earlier, is the key to market direction.
What's the sense of consumer spending? And I say this because at the same time that you have Fed officials saying we're not seeing signs of slowing, it's not trickling in as quickly as we would like, we see the likes of Kohl's having a really hard time. We see the likes yesterday from some others having a really hard time. Target not doing well. How do you parse out the winners from the losers with some sort of narrative that really gives you a sense of where things are heading?
Well, there's two different narratives that you can start to interpret from the retail sales data as well as the earnings from these companies. First of all, you look at the macro picture and say, what does that mean about what the consumer has left to spend and where in the consumer spending bucket, who's getting most affected? And there's no doubt about it that the low-end consumer is squeezed more. That's not surprising. That's what we've historically seen. When you see food and gas prices up over time, that's what's happening. Walmart, we know that they noted over 100,000 consumers are spending more on groceries at Walmart, right? But then you start to differentiate between these retailers and you look at a franchise like Costco, membership-based, huge loyalty, done an excellent job, not just on supply chain, but on labor, and it makes a big difference. So I think when it comes to the micro, the time now is for stock selection and company differentiation. Companies are different in how they're able to manage the chain and labor as well.
You're talking my book. But what I love in your research note, and you get down to something that was gospel in my house, SPX midterms up 16%, presidential year up 8%. You got to be kidding me. The history of these midterms we just had inflicted upon us is double-digit SPX return.
Well, we have to be careful saying history always repeats itself.
Come on, stay with me. It's showbiz. Stay with me here.
It would be awesome to see a 16% recovery post the midterms. That is what history said, Tom, and that is what we've published. But you got to get back to fundamentals and stay balanced. I mean, Lisa's point earlier about surprise. You don't want to be playing the game of trying to switch asset classes and sectors in a fast way here, because there is so much surprise that's possible in the market. And I think the midterms are some element of surprise as well, obviously. So I think you have to be humble and you have to be balanced.
Okay, you got to be balanced, but do you buy quality? I mean, you buy small cap quality, mid cap quality, big stuff, Apple, whatever. Give us a differentiation of those sectors that create the active alpha you're predicting.
Yeah, you must have read our note. Quality growth is an area.
My people read the note. I don't read the notes.
Yeah, quality growth is an area that we like, and I think we like it most in the large cap space. Small caps are interesting as well, but obviously we feel we could be entering a recessionary period. And even if that recession is mild, small caps could be more vulnerable.
Lisa wants to jump in here, but this is critical. Are you going to see record use of cash by those big cap quality names?
I think we could. I think they've got more strength in their balance sheets. They've got more ability to maintain quality just on labor as well. Obviously, you're seeing cuts and ad spending and in tech, but there's still quality names like Microsoft, like Visa, that we find attractive.
I know, this is what your zombie roll-up thesis. This is what you're going with this. I know exactly where you're heading. Carry on. But I do wonder, Viana, just to build on that, because it is an important point.
Me like that.
It's an important point, this sort of question of what's going to lead to the catharsis where you get capitulation by companies to be purchased at a discount from other companies. At what point you get some sort of washout. What are you looking for to signal? And I understand company specific, but on a broad level, are we there yet? How do you know?
In terms of company risk-taking to lean into...
In terms of stock valuations, in terms of the appetite of investors.
Yeah, I don't think we're at total capitulation. I mean, we think we may have seen the bottom. We feel like we're in a range-bound market, somewhere in the 3,600 to 4,000 in the next 6 to 12 months in the S&P. Our base case is for an earnings decline that we have not yet seen factored into the market. Those bottom-up earnings forecasts are just starting to come down. You're starting to see 22 come down, 4Q come down. 23 hasn't yet been touched. Right. And that's because that visibility is so murky. Everybody's struggling with the ultimate Fed question. But you're seeing companies starting to respond on cost management. That's going to play out on margins. And that bad news for people is unfortunately good news ultimately for the market and for earnings.
What's fundamental here is we now have a risk-free rate. We now have finance somewhat back to what we were weaned on. And my great theme is the zombies of all flavors are going to be rolled up in 2023. Bernstein's heritage, the black books of Bernstein's heritage is studying that. Do you see combinations and transactions on fire next year?
I don't think we've put out a forecast for M&A volume.
No, I know you haven't put out a forecast. So just, nobody's watching. Come on, help me.
We're continuing to see M&A volume be robust. I think what you're seeing here is financial conditions and risk-taking obviously have gone up recently, and I don't see a real change to that. I think companies are continuing to innovate and invest for the future, and if they can do that with roll-ups and mergers, then why not? Right, but I think they're going to be opportunistic.
Beata Kerr, thank you so much. Greatly appreciate it with Bernstein Private Wealth Management today. Lisa, there's a wow headline if I've seen one.
Yeah, there's just coming across right now that Tony Blinken says that Biden asked him to travel to China early next year. That was really kind of building on what we expected coming out of the Xi Jinping meeting was that Tony Blinken is going to head over to China. What are they going to talk about? And I think this is important. Are they going to talk about the chip sector? Are they going to talk about Taiwan? Are they going to talk about how they deal with Russia? How do you sort of rank your priorities at a time of some pretty serious red lines?
But by quote, early next year, we will have a much better framework of the slowdown of China or the stability of economic China or the recovery of economic China. So
or the reopening of zero COVID.
There's a lot of debates out there about China. To me, it's the uncertainty in the next year.
You know, there was something that happened overnight.
The financial stuff.
The PBOC warned that if there was some sort of reopening, it could cause an inflationary push that they weren't expecting, and it's going to affect their easing and how much they're willing to ease. It just speaks to a preparation, gaming out what this looks like as China clearly needs to reopen into the rest of the world.
Well, it's going to be fascinating, and Elizabeth Economy now with Secretary Raimondo at Commerce has just always said this is fragiler. That's a new word I'm inventing.
I like it.
It's fragiler than it looks. Futures deteriorate negative 1.2% on Standard & Poor's, negative 47 points. The VIX breaks out over 25. Some fragility in the market into that important economic data. We'll see at 8:30. We look at FTX at 8:45. Stay with us on radio and television. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, in the companies, there will be higher taxes on wages and dividends for the wealthy, and there will be an almost real-term standstill in spending on public services at a time when demand for them is growing. Ukraine's President Volodymyr Zelensky has laid out his conditions for peace. Zelensky says only the return of territory taken by Russia will allow an end to the war, and that includes Crimea, which was annexed in 2014.
Crimea is part of Ukraine. This is not just a state within a state. It's part of our country and part of our sovereignty. Therefore, indeed, the occupation of the Crimea and Donbass will bring the end to the war.
Zelensky spoke to the Bloomberg New Economy Forum in Singapore. More than a week after the elections, Republicans have won a narrow majority in the House that gives them the power to halt President Biden's agenda. Still, their slim margin is a letdown. The party had counted on decisive election results as a springboard for the 2024 presidential race. And Macy's reported third-quarter earnings that beat estimates. The department store retailer also raised its full guidance. And that's a sign that it has succeeded in luring shoppers despite consumers shifting away from discretionary spending. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Gen Z can't seem to get enough of Prada. Loafers, nylon bags, and its Miu Miu micro miniskirt have been flying off the shelves into and onto the arms of young consumers. Fashion tech company Lyst placed Prada second on its fashion index at its highest ever ranking. So what could be making this over a century-year-old fashion house appealing to a new generation of consumers?
What Prada has navigated adeptly is their overall kind of understanding of how cultural conversations are happening online, their ability to partner with various cultural figures.
Gen Z faces are at the front of Prada's advertising to this new market. Maya Hawke, Hunter Schafer, and Sydney Sweeney will be familiar to any fans of Stranger Things or Euphoria. There could be another factor at play, the environment. Of those surveyed by The Lancet, over 59% of Gen Z said that they were extremely worried about the climate crisis. So, for example, the revival of Prada's iconic nylon handbag using eco-friendly materials may be winning kudos among these shoppers. Of course, Prada and Miu Miu are not inexpensive brands, and as the global cost of living crisis hits, these brands might start to feel a pinch. But, for now, Gen Z seem to be reaching for their nylon handbags and not letting go.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. No covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
One of the biggest challenges economies around the world are facing is inflation. I think what central banks around the world have clearly recognized is that they need to move in a determined fashion to durably bring inflation down.
Gita Gopinath of the International Monetary Fund, not at the spring meetings, not at their annual meeting in Marrakesh next year, in Singapore with Bloomberg, our new economy forum. That was a wonderful panel. Our Stephanie Flanders in conversation with Axel Weber, of course, formerly with the Bundesbank, and with Dr. Gopinath as well. You can look at that for that across all of Bloomberg media this morning. I thought it was sort of not a snooze fest, but we'd slide through Thursday. Lisa, I was wrong. Claims in 12 minutes. Housing, which is a mystery. No one, anybody, particularly with means, that's all they're talking about in America. And then we've got BitDog, and we've got, an important conversation coming up here at 8:45.
Yeah, the idea here that FTX bankruptcy lawyers, I mean, this story is sort of delicious for people who like the drama of it, but it's really tragic for those people and individuals who are losing their shirts because it went to zero overnight from billions of dollars. The FTX bankruptcy lawyers accusing their client of gunking up the case because they basically hear him coming out with these direct messages to reporters talking expletives about regulators and what they've done to people.
Suddenly, Bitcoin sell. Thank you for that. The control room just killing it today. They're not looking at the World Cup things. They're actually paying attention to the show. Unbelievable. 16,700. Down and spiking down now, down $300, and that matters. I mean, these little moves matter right now.
Yeah, but there's a broader point here, which is that as accommodation comes out, what does that mean in terms of who is exposed, right? There was that tweet from Brian Chesky of Airbnb that when the lights go on at the end of a nightclub at 2 a.m., you sort of see what's left over, and that's what it feels like right now. And how much is that we're going to see? How much more of that is there going to be out there?
Very good. Nick Benenberg joins us right now. He's international economist at Wells Fargo, and maybe more than anybody I know, nails foreign exchange more on a longer-term basis as well. Let's dovetail your work over the years with foreign exchange into international economics. Is the study of the dollar, is the study of foreign exchange valuable in gaming out international economics right now?
Well, yes. I actually think maybe the study of international economics is more helpful in terms of the dollar because we're definitely seeing differences in growth. Europe's already in recession. The United Kingdom, the Eurozone is very, very close to being there, whereas the US is holding on, pretty well. I think that's going to be sort of more influential in just the relative growth trends helping the dollar for now, but seeing the dollar depreciate later.
So the study, and forget about Q4, we're almost through it. The study into next year, is it a study of what the U.S. will do, or is it more centric on what Europe will do, Japan will do, a beleaguered United Kingdom will do? Which side of that trade is the one we should focus on?
I think there's always a focus on the United States, and, perhaps quite rightly so, the largest financial market, the largest economy in the world. And as you earlier noted, a comment here or there from the Federal Reserve policymakers, and we've seen, yields higher and the dollar higher as well. So I think that's where the surprise is going to be. We believe that the Federal Reserve funds rate is going to go above 5% up to 5.25%. And so I still think it's Federal Reserve monetary policy for now that's going to drive the dollar a little bit higher and keep those foreign currencies probably on the defensive.
Let's talk about some of that monetary policy. Jim Bullard in comments talking about how we're not yet restrictive, also saying this. He cites policy rules suggesting rates between 5% and 7%. This is Jim Bullard of the St. Louis Fed moments ago, or about a half an hour or 20 minutes ago. How much are we looking at something that is going to cause the dollar to surge to levels that people are not expecting and cause some sort of fissure here that needs a response?
Well, I mean, those rules or those targets are, probably a moving point. And I think a 5% level, and 7% is a long way, but I think a 5% level is reasonable when you've got these inflation numbers at 7 or 8%. Now, I think longer term, maybe in the region of 2.5 to 3 is kind of more reasonable. But I think in the current context, these very high rates are more than appropriate. I think, from your perspective, or the other part of your question was, will we see the dollar surge to levels that we haven't seen before? I think we'll get back to recent peaks and maybe slightly above. But for now, the dollar's moving higher. But the end of the inflation problem is probably in sight, and so we'll probably get back to recent highs, not go above them.
What would an interest rate, a federal funds rate of 7% do to an economy with this much debt?
That's the Bramo. Nick, I'm sorry. She does this. She goes excessive.
Well, it would probably, we already think there's going to be a recession with the high inflation weighing on purchasing power, with these, housing market being affected by these high interest rates. So unfortunately, it would be a deeper recession than what we would expect. But again, not the pandemic and not the global financial crisis.
Did you say 7%?
That's what Jim Bullard of the Federal Reserve of St. Louis said that it could get up to. Of course, that policy rules suggest rates between 5. It could be irresponsible. What would Dudley say to that? He might be in agreement because he was someone who got out front. But my question 7%? Is, the issue has been this market has been able to tolerate interest rates well beyond what anybody thought previously were expected. So now we're suddenly readjusting to a new normal.
Nick, you've done so well over the decades in gaming the markets, and particularly your expertise in foreign exchange. I'm absolutely fascinated by if you think all these fancy people are overcome by events. And that if you get 5% or 6% or 7%, whatever the nation is, they're overcome by the politics of it, including what we saw in the United Kingdom this morning.
Well, I don't know if they're overcome by it, but again, I think that we're going back to levels that we haven't seen in a couple of decades. We've got inflation that we haven't seen in a couple of decades. It's all a moving target, and no one really knows where the peak is. What I would say, though, and again, why we think interest rates don't go to 7, maybe they get to 5, why we think the dollar gets back to its previous peak, is we're starting to see the first encouraging signs on the inflation front. Those supplier delivery times are down a lot, the commodity prices are down, some of the shipping costs are down. So, we think there's still some further dollar strength to go. There's still some interest rate increase, but we're pretty heavily focused on sort of the first quarter, second quarter of next year as being the peak, and hopefully things will improve from then.
Nick, thank you so much. Nick Benenbrook with us with Wells Fargo this morning on international economics and on a dollar. DXY 107, haven't followed it against the Bloomberg Dollar Index this morning, but yen, and there we were looking at a huge move, 139 now 140. Just a churn, I'd say, to foreign exchange, Lisa, over the last number of days.
It's been a churn with a consensus from an increasing number of people that perhaps the dollar has peaked, right? And if it hasn't peaked, that it's close to it, as we were just hearing from Nick. How much is that going to sort of give some sort of bottom, frankly, to where stocks can go? Because that has been one of the big drivers, right? The dollar strengthens, and that's been bad. The dollar weakens, that's been risk on. How long can we continue that?
Futures negative 43, Dow futures negative 323, NASDAQ down 1.2%, the VIX at a 25 level, 24.93. Yields move, no other way to put it. 369 on the 10-year yield is a higher yield, 3.76%. And on oil, I'm going to call it quiescent, $92 a barrel, off $1 on Brent crude. The foreign exchange market, you heard Nick Benenbrook talk of resiliency here for a while in U.S. dollar. Dollar stronger today. Please stay with us. John Riding of Brain Capital, then Katie Greifeld on Bitcoin.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance, is moments away from some prints, both with respect to jobless figures as well as housing starts, housing permits to build new construction. Right now in markets, a bit of a sell-off after some of the comments out of Jim Bullard. Right now, with some of the data starting to trickle out, let's head over to Bloomberg's Michael McKee.
Good morning, Lisa. Well, we're seeing all of the data now on the Bloomberg, and initial jobless claims look like they have gone down just a touch, 222,000 from 225,000. We'll see what that previous number was revised to. Continuing claims do continue to rise, 1,507,000, up from 1,493. So some of the people who are losing jobs are taking longer to find new ones. That's what that's telling us. But it's 222. It's still pretty low in terms of layoffs. The layoffs going on at Twitter and other places in the tech industry not really having a major effect on the national numbers. Housing starts are up for the month, 1,425,000. That is an increase of 4.2% over the revised September estimate. It's 8.8% below where it was a year ago, however. Building permits are a little bit lower, 1,526,000 from 1,564,000. That's a 2.4% drop, and it's 10% below where they were a year ago. Now, that's not going to surprise anybody. Housing numbers have not been good. Philadelphia Fed puts out its index, and maybe this is the more interesting number of the day. The Philadelphia Fed index drops significantly to 19.4 from 8.7 from negative 8.7. So a significant drop there, suggesting business really slowed in the first part of November, end of October, and the prices paid index falls to 35 from 35.3 from 36.3. So still some progress being made on prices there. Employment is way down, 7.1 versus 28.5. Now, these regional Fed indexes don't necessarily tell you national trends, but when you get them all out and add them together, it does suggest where we might be going in terms of things like the ISM number, which we'll get the 1st of December.
Michael, let you parse through some of the details. Just want to bring to you what the market's doing, which isn't that much if you want to be honest. You're seeing yields come off just a touch, and you're seeing equities pretty much stay around those lows in futures. What I'm looking at right now, Tom, is a story that stays pretty much the same. We see housing having issues, definitely deteriorating. The jobs picture still pretty strong. The idea that you're not seeing that pop up in jobless claims that you'd be expecting, which really raises a question of how far the Fed will have to go.
Michael McKee, my tweet of the day yesterday was Jason Furman of Harvard. He teaches a small course called Ec 10, retweeted by the laureate Paul Krugman, over how rents fold into all the Michael McKee analysis. And the answer is, you've got a bigger number of core inflation based on older locked-in leases. But when you use the spot rent market, core inflation cascades down to a more gentle 2.8%. Discuss that, Mike. Is that a valid study?
Definitely a valid study, and it's something that a lot of people have been talking about. The way the government computes the CPI, they take not just new rents, but existing rents, and those aren't going to change because they're already in place. Now, the Zillow numbers, which Jason Furman was talking about, and there's also another private one out there, those look at new rents only. And if you look at new rents only, then rent prices are dropping significantly. Rent's been the biggest driver in the CPI. So the question becomes for the Fed, do you pay attention to what's in the CPI and to a lesser extent in the PCE, because you know that those prices are going to go down. It's just a question of time. It's actually happening right now, but it won't be reflected in the data for a couple of months. And I think the Fed is probably looking beyond some of those housing costs in CPI, seeing this other private data come in and seeing that it is suggesting that housing inflation is going to go down.
Michael McKee, thank you so much for breaking this all down. We'll catch up with you later in the morning as well. Joining us now, nobody better to speak about what we saw over in the United Kingdom, as well as the potential agony over lag effects, how to understand them. John Riding, Chief Economic Advisor at Breen Capital, former Economic Advisor to the Bank of England. On this Thursday, John, when you take a look at some of this data, which isn't softening quickly enough, and you hear the hardline talk from the Federal Reserve, what's your sense about how far behind we are in terms of lag effects and when we'll actually see the ramifications?
Well, Lisa, as you know, we had many discussions last year where I said that inflation was not transitory, was going to be a real problem, you know, and it still is. And I mean, interestingly enough, in the numbers that Mike went over, you know, he didn't mention the prices received data by manufacturing firms in the Philadelphia region, which, like in the New York region, went up to 34 and change from about 31. So we're far from having defeated inflation at this point. And I would also take a little bit of issue on the rent story for two reasons. One of which is rents in the CPI are rising roughly in line with the overall CPI. So they're neither adding nor subtracting to the overall rate of inflation, where people, you know, paying for housing, paying for food, paying for energy are really important in forming people's inflation expectations. So the fact that new rents are declining when people are paying the higher level of existing rents, I don't think it's inappropriate. But this idea that we always take out the bits that are pushing up inflation and look at inflation excluding that, you know, I find a bit problematic because policymakers never do it the other way.
Okay, this is really important because there are all these people coming out there, and this is the biggest pushback and the reason why we've gotten lifts in markets. People say there are disinflationary elements, and you pointed to the rent story, you point to the used cars, you push back, and you say that those are completely offset and then some by the other indicators. Is that right?
Well, yes. I mean, we've had, and I actually think Fed policymakers are somewhat on top of this. We've had 3 times this year, 3 months of the 10 months which we've had CPI data, where the so-called core, excluding food and energy, only went up by 0.3%. And it was then followed by inflation picking up again. So yes, one report where you got an odd treatment from healthcare costs. Health insurance costs fell 4% in the CPI. Now, I'd love to have that health insurance policy, and I'm sure most people out there would love to have that, but I don't think anybody's health insurance costs fell by 4%. But my point is, inflation is the overall price index, and you can pick and choose and take this number out and take that number out. But the reality is, inflation both here and globally is a problem, and central banks have created, or at least made the problem worse, by staying too easy for too long after the pandemic. And that liquidity and that stimulus has to be soaked up. Now, just 1 second, Tom, if I may. Please. There is a communication issue going on at the Fed, a further change in communication. Say, look, there's 3 things about policy. How fast are we going to raise rates? And they've clearly signaled they're going to slow the pace of increases, and the market's got that story right. Then how high are we going to raise rates to? And then how long are we going to keep them there? And I think the market's got the how fast right. It's slowing. But I still think we're offside on how high and how long rates are going to stay there. Markets are pricing in barely reaching 5% on the Fed funds rate, and then the Fed quickly cutting rates thereafter.
I'm amazed by that conversation. Absolutely. I totally agree with you. I'm amazed by the certitude that they're going to do a pivot or whatever you want to call it. This is an historic day. The Chancellor of the Exchequer stood up and said, we have austerity. You and I read Paul Johnson, 1987, The English Disease. It was a beautiful essay about the struggles of Clement Attlee, Churchill, and the rest coming forward. What is the level of crisis in your United Kingdom right now? Is it something that's solvable? Is it a 2-year recession, as Bailey talks about, or is it an English disease that is larger?
I think that's a very difficult question to answer. I think the finances of the economy, prospectively going forward, are in better shape now than they were prospectively with the budget, the mini budget that's put forward in September that helped spark the whole crisis in the gilts market. But the UK is still struggling with Brexit and struggling with inflation issues. And the Bank of England, I don't think, has raised rates quickly enough or early enough to get on top of that. But now we're faced with this very interesting question. I think the US may be faced with it. Can policymakers raise rates enough, tighten policy enough to get inflation under control without sparking a significant
is the
financial
Phillips curve
crisis?
operative right now, and the financial stability John Williams talked about yesterday? Are these traditional theories operative right now?
Well, I think the Phillips curve hasn't been operative since the late 1960s, and I think it is very,
I knew what the writing answer.
Very interesting that
it gets them going.
Very interesting that the very flat Phillips curve that policymakers talk about, we can keep pushing unemployment down without raising inflation, comes back as something that's going to cure the inflation problem. I mean, the main thing about inflation is expectations, and having people and companies understand that higher inflation isn't going to be allowed. And what we have in, for example, in this Philadelphia Fed report here, we saw it earlier, is company cost increases slowing, but the price increase is not slowing. Now, yes, the October numbers were a little bit encouraging, probably most in the PPI, but there's a big difference between inflation having peaked at levels we never thought we were going to get to and getting back to price stability.
John, quickly, John from a Christmas tree farm north says, ask him about England, U.S. in the World Cup.
A nemesis team. We lost 1-0 to the U.S. in 1950 in the first World Cup England played in. And then back in 2010, we tied 1-1. Day after Thanksgiving, it's going to be a great time, and I'm going with England, obviously.
I'm shocked. John Riding, thank you so much.
Thank you.
I think John Farrell's going with England as well. That means you and I must go with the U.S.
Clearly, obviously. I don't know if he is going with the UK. Let's see.
After Lions-Bills, we'll be able to watch England, U.S. Coming up, Katie Greifeld on Bitcoin.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Chancellor Jeremy Hunt has outlined a $65 billion in tax hikes and spending cuts so the government can plug a hole in the budget. The wealthy will be hit with higher taxes on wages and dividends. Meanwhile, a windfall tax on oil and gas companies has been extended. It's a power shift in Washington, although not as big as Republicans had hoped for. The GOP has won a narrow majority of the House that gives them the ability to block President Biden's agenda. House Republican leader Kevin McCarthy tweeted that Americans are ready for a new direction and Republicans are ready to deliver. Democrats had controlled the House the last 4 years. A senior IMF official says it will take some time for the full extent of this year's interest rate hikes to become apparent. Geeta Gopinath also looked at what comes next for the Federal Reserve.
They are very likely to raise interest rates another round before the end of this year. And then the question is what comes next. And I think for 2023, the question is more about how long are you going to keep these rates at the levels that they've moved them to.
Gopinath spoke at the Bloomberg New Economy Forum in Singapore. In China, COVID restrictions are still impacting consumer sentiment. Alibaba reported a surprise loss after quarterly revenue barely grew. Meanwhile, the online retail giant announced a $15 billion expansion to its buyback program. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus. And Bill Belichick sees him and cuts him on the spot. In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
In the area of stablecoins, that it would be important for Congress to step in and say, you're not permitted to offer a stablecoin unless it's done under a strong prudential framework with Federal Reserve oversight, supervision, regulation, and approval.
Michael Barr, the vice chair for supervision at the Federal Reserve System, there talking about stablecoin. Yes, only stablecoin I know is when somebody has a full-time job in the House. But there we are, Mr. Barr talking about the upset of the moment. Welcome to Bloomberg Surveillance Crypto. We do this with Katie Greifeld, and I got a number of ways to go. Let's bring up the chart of Bitcoin right now. And what you need to know, it's a series of lower highs since November 14th and has rolled over ever so slightly in the last hour, down $62, under 16,500. When all of these players look at the price of Bitcoin, how does that correlate to their future? How are they linked to the price of Bitcoin? FTX, Mr. Silbert of, is it DGC or
DCG?
See, I got it. Whatever you said, I agree. But how is it linked to the price of Bitcoin?
Well, if you go to SBF's tweets, there's a lot of letters here. If you go to Sam Bankman-Fried's tweets, basically, he said that FTX was over their skis on leverage. Maybe that's not such a horrible thing, or it's less bad when the line is going up, but that chart's amazing because it just shows, like you said, this grind lower, this continued step down, and now we're sitting at 16,000 on Bitcoin. It's a lot easier to sort of cover up brewing ills in a bull market when the lines are going up. Obviously, that's not happening anymore.
You and your colleagues published on Mr. Silbert last night. This is really important, folks. This guy is not SBK. He's not dashing around talking to Tom Brady. This gentleman from Connecticut out of Emory University, and all of a sudden, Barry Silbert's called into question. What do you mean by that?
Well, think about what happened at Genesis. So DCG, that is the parent company. It's one of the biggest, most important empires in crypto that isn't really talked about much in mainstream media because unlike SBF, unlike CZ over at Binance.
See how she just insulted me, calling me mainstream media? Let's continue.
I've spent too much time on Twitter. I'm sorry. But basically, Silbert controls what was a $10 billion crypto empire. They raised money at that valuation just last year. But yesterday, sort of the crown jewel in the empire, that's Genesis. It's a crypto lender. It suspended withdrawals, which...
Do you expect news from Genesis this morning? I mean, all the focus, the media focus is on, is it SBK?
SBF.
SBF. Okay, that's a publishing company out of Los Angeles, excuse me. All the focus is on the guy going into bankruptcy. Are we wrong? Should we focus on Mr. Silbert? And do you expect news there today following on the shock of yesterday?
I think there's a lot of really deserved attention paid on SBF. Just the unravel has been fantastic, but it is really important to watch the fallout here. Watch big lenders such as Genesis. If you had asked me 2 weeks ago, would I expect news yesterday, I probably would have said no. But given how fast everything is moving, it's something to watch for. Bloomberg has reported that Genesis has hired advisors to look at options here. We don't know specifically what those options are, but they've hired people to that effect.
Unfair question, but it's Unfair Thursday. Fossils like me and the ever-young Liz Ann Saunders all say, why hasn't Bitcoin gone down more? How do you respond to that?
No, Tom,
it's my only good question of the day. Stay with me on this. Why is Bitcoin not trading at, you name the price?
I actually tweeted to that effect yesterday, and the tweet got 2,000 likes. Why isn't Bitcoin lower? When you consider the just 2 weeks that we've lived through, and the fact that we're still at $16,000. It's not $69,000 where we were a year ago, but there is this resilience sort of built into the market. Even today, Bitcoin.
Is it a market? That's the key question. See how she looked at me on radio, folks? She was looking at me like, what do you mean it's not a market? Come on, the regulators like Michael Barr are saying aren't sure this is a market. So it's gone 60,000 to 16,000. How does it get down lower other than one of these elephants just saying go to cash?
Well, that's who's left. It's those elephants. It's those whales. That's the answer I keep getting when I ask people, how isn't Bitcoin falling more? It's that everyone who would have sold has already sold. And all you're left with is these big accumulators, sort of these big hardcore believers who aren't going to sell at this point. I mean, maybe they bought into Bitcoin when it was $7, or it's these big institutional players. And until you see one of those chips fall, I mean, you're pretty much out of floor.
Rachel from West Lafayette emails in. She must be at Purdue University. And Rachel asks, what about the Winklevi? I mean, that's all anybody knows. These people like me, dumb, we focus on the Winklevi, and they're linked in to Genesis, right? And Mr. Silbert?
They are. So that was, again, one of the ripple effects from FTX through Genesis into Gemini. There's a lot of letters. There's a lot of G names, too, something to think about. But it's the Winklevi twins. Yesterday, they had this product on their platform, Gemini, called Gemini Earn, which basically...
Oh, come on, now you're going to get me going.
But that was their
this
problem.
Is family television.
Because their big problem was that one of their huge counterparties was Genesis. As far as we know, the site's up and running, but that's, again...
I'm going to talk like, not me, folks, but this is the critics out there, including Noel Rubini. If you give me your money, we can monetize Bitcoin and make 8% or 10%. That's the game, right?
Yes.
How do you regulate that? I mean, some, not me, but others would say scam. Those of a certain vintage would say executive life, 1970, whatever, 14% annuities. What's the difference here? I'm going to make 10% on BitDog.
Well, again, when you strip it down the way you just did, it sort of exposes it as lending money in a circle. I would understand how that's hard to regulate. I'm not a regulator.
We call that the American government. Continue.
But again, it gets back to the point I made at the beginning. When the line is going up, that works to of lend money in a circle. When you are looking at an 80% drawdown in a year and just the price of Bitcoin, there's other smaller coins that are down much more dramatically than that. That gets harder to do. Those returns just aren't there. You're hit with the liquidity issues that we're seeing rippling through the space right now.
Unfair question. Let's finish with this. Katie Greifeld, 16,470. Where in your head is a tip point, a dispersion point where this unravels? Is it 15? Is it 9? Is it 12? Do you have a number in your head, or our experts have in their head?
I don't have a number. I would say when we get to the single digits or below that 10K level, maybe that's where it gets interesting, because this market loves big round numbers for better or worse. There seems to be some important, I don't know, stops set up there when I talk to people. So we'll see. But as I said, you would have thought it would be down a lot more.
Did I do okay there?
That was good. I think
when you're on, I get so much hate mail. It's like, you know, I mean, Farrell gets all these love notes, and I get nothing. Every time you're on, I get absolutely crushed. Are you publishing today, seriously, Mr. Silbert?
My boss would certainly hope so.
Okay, well, slide it out to an 8-hour workday from 6 hours. Katie Greifeld, there on all that's going on in this, and we'll continue to follow this. I really want to commend on radio Paul Sweeney and Matthew Miller in the 10 o'clock hour with some solid knowledge on all of this. For people like me, distant and removed from this, I learn every time they open their mouths. And I guess Crypto Show, did they get to Tuesday on the Crypto Show?
Yeah, that was Tuesday.
I mean, they got another one coming up next Tuesday.
Yeah, right? We got to wait all the way till then.
Well, we should do one every day, the way this is going. 16,462. The markets have deteriorated through the morning. SPX negative 52. The VIX 25.12. Please stay with us. This is Bloomberg. Good morning.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
City for our viewers worldwide. I'm Lisa Abramowitz in for Jonathan Farrow. Every time the market tries to rally, the Fed speakers come out and jawbone it down. Fed speaks, markets listen, stocks down 1.3% ahead of the open. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Issue, timing the growth shock.
The key issue at the moment is the sequencing.
We're going to see the growth slow down.
It's timing that, trading that. That's going to be hard.
If you asked us 3 months ago, we would have thought it was, Q1 to Q3.
You won't really see the full effect of this tightening probably until, possibly even the midpoint of next year.
Now it's looking more like a Q2 to Q4, maybe even as late as Q1 of 2024.
There are significant lags to Fed policy.
You're going to see a big lag.
That's going to be a bigger problem.
The lags between monetary policy tightening and the effects in the real economy.
The investable windows are really, really short.
This is not a time to get too cute.
It's the window between, hey, inflation looks like it's peaked.
We have seen now inflation come down.
And, the unemployment rate is rising and other forms of economic growth are slowing.
That's a lot of gloom. Joining us now to parse through what it means is JP Morgan's Tom Kennedy and Samir Samana of Wells Fargo. Really a pivotal moment with two amazing people to really discuss this. I want to start with you, Tom. With all of your experience on the Federal Reserve, how much are you looking at a lag time? What kind of delay are we looking for this growth shock?
Good morning, Lisa. Yeah, the lagged effect is getting a lot of attention. I think we have to take the big zoom out. The Fed really only started tightening conditions 9 months ago, and it's going to take some time. The classical progression of the lead lag, so tightening of conditions and what it would mean for the economy, the housing sector is the first place you're going to see it show up, and unfortunately that sector is in a recession already. Housing starts down 20+% from the peak. Mortgage applications are 2011 all over again. So you're getting the desired impacts there. The next phase as it moves into corporates, that's only just begun. So in our base case, it's likely you're going to end up seeing unemployment start to tick up in Q2 and recession time most likely, should it come, middle of next year.
And JP Morgan's Michael Feroli is projecting that mild recession in the United States next year, writing, quote, the almost 500 basis points of expected cumulative hikes is already delivering a commensurate tightening of financial conditions, which we believe will tip the economy into a mild recession later next year, talking about how firms are hoarding labor and the economy could still shed over 1 million jobs. Samir, from your perspective, how much of this has already been priced into the equity markets?
That's a great question, Lisa, and it's probably the key question. And as you know, I was hearing kind of the comments from the previous speaker about the lags in the economic activity. I was thinking about the lead that the markets tend to have, right? When you look at crypto, when you look at equities being down this year despite earnings growth being positive, to me, the markets are running well ahead of it. And so if the economy kind of troughs out in the second to third quarter of next year, there's a pretty good chance that the equity markets and other risk markets will probably trough in the first quarter of next year.
Well, and this is the issue, is that we were waiting for something to drop. And Tom, yesterday we heard from a number of Fed speakers, including John Williams of the New York Fed, talking about how you are going to see some problems and that is not the mandate of central bank policy. They want to go some problems, and that is not the mandate of central bank policy. They want to go to fight inflation, not necessarily to dampen any potential risk in markets. From your perspective, what kind of shoe could we see drop? What kind of financial stability risks could we likely see coming from here?
Yeah, I think the broad conclusion from this round of central bank speak is the Fed is not ready to get off the financial conditions merry-go-round, if you will. They haven't seen enough growth impact, even though we're all expecting that deterioration, and inflation still remains too high. So they have to see that growth deterioration. They also will need to see some more of these desired impacts on inflation. Inflation needs to come down to get rid of that entrenchment risk that Chair Powell's been talking about a lot. But along the way, Lisa, I think of it as central bank, when policy is this tight, they're shaking that global tree. The global economy is being shaken by the Fed, and who knew that the UK pension system had leverage in it? The crypto system, surely we knew, had some leverage, but didn't see where it was. These are the apples that are falling. I mean, it's hard to know what these things are in real time, and we all think about them regularly, but this is a consequence of this situation, and I don't really spend too much time trying to figure out exactly what it would be, mostly because the Fed has two priorities ahead of it, which is getting the desired effects on growth and inflation coming down.
Samir, how do you, when you're picking certain stocks, figure out whether something is a bubble that has already bursted or something that is still vulnerable to some of these sort of systemic shocks that may be out there, those apples that could fall, to use Tom's words?
Yeah, so we started a lot of this process late last year from the standpoint of going up in market cap, going up in quality. We didn't know exactly what was going to transpire this year from a Fed policy standpoint, but valuations were well ahead of, kind of what history would tell you would be, anywhere close to fair. And now I think you're starting to see the opposite, right? When you look at vulnerable areas like small caps, look at vulnerable areas like emerging markets, they are cheaper. Now, again, it's still probably much too soon to kind of step into those areas. We're still unfavorable on smalls. We're still unfavorable on emerging markets. We're still most unfavorable on developed markets. But that's what we'll be looking for, is valuations probably will get there before some of these other things start to turn. So I think that's probably what our eyes are trained to, is not so much what the Fed's doing, not to take anything away from what they're trying to do now, but unfortunately this Fed will always have the label of being the transitory Fed. And so they'll probably be late to declare an end to inflation and late to pivot. Markets will probably get there before, and valuations will be the key.
And this is the issue that a lot of people have been basically looking at the Fed speak, and there is a lot of it, and shrugging off the hawkish calls and looking at the dovish ones to sort of sniff out that pivot before the Fed itself. Let's talk about that chorus of Fed officials voicing their support for a slower pace of rate hikes. Governor Chris Waller becoming the latest to throw his weight behind a downshift.
Looking forward to the FOMC's December meeting, the data of the past few weeks have made me more comfortable considering stepping down to a 50 basis point hike.
That sounds good. That sounds bullish, at least for some looking for a pivot, but it isn't necessarily at all when you take a look at some of the other Fed speak. Bloomberg's Michael McKee is joining us now.
Yeah, Lisa, Chris Waller made some news overnight, and it was affecting markets, and then his St. Louis buddy Jim Bullard came out this morning and said, hold my beer. Jim Bullard saying, we are going to have to go much higher than we thought we would have to go, even under the generous assumptions, he said, that people are looking at. They're not in a zone that's restrictive yet, that they've got to increase the terminal rate further. And further means a lot further than Wall Street's thinking about. Under an optimistic scenario, he says we could get to 5%. Under a pessimistic scenario, 7%. And that's what has everybody on Wall Street running for their lunch buckets this morning, is they are a little afraid that maybe he could turn out to be right. And it is not what the market has been expecting. You look at what's been priced in, and they're looking at the step down. You can see there to 50 basis points in December, then step down to 25 basis points. And then in May of next year, you start cutting rates according to the futures market, 25 basis points at a time into 2024. The Fed is trying to push back against that, it appears. Not only those who say we could step down to 50, they're also saying that they are not done yet. Nobody's put a number on it like Jim Bullard. Here's the data to watch as we go forward. Keep an eye on the PCE index that comes out at the end of the month, the sequential month to month. As you can see, we saw a big decline and then it went up the last 2 months. And that's not what the Fed wants to see. It wants to see continued drops. CPI, the increase fell. Let's see if that happens with PCE. You can see just a little bit of improvement. Well, it's kind of a weird way to put it, Lisa. Improvement in unemployment because it goes up a little bit, but unemployment's going to have to rise some for the Fed to get where it wants to go. We don't know how much it would have to rise to get to 7%, though.
It's a weird year to talk about economics and talk about the good news and bad news and all of this stuff. Michael McKee, thank you so much. I want to sit on that one point. Jim Bullard talking about potentially a 7% Fed funds rate. Tom Kennedy, Samir Samana, both with us. Tom, from your perspective, is this plausible, a 7% Fed funds rate?
It's certainly plausible. I think that's in the entrenched inflation scenario where the behavioral mindset of inflation changes. And this is what Volcker broke many decades ago. If that happens, you have, and it's art, it's not science to this, but the longer inflation stays high, that possibility remains. And that would necessitate a much deeper recession. And I think that's the scenario where you can get towards 7%. I think what's really challenging, in my view, to get there is inflation is rolling over. We are finally seeing the disinflationary pressures from supply chain confusion, if you will. Inventories are building, and you can look no further than PPI, which has been slowing for many months now. And from there, you have to say, well, how low can inflation really go, and what is the level of inflation the Fed is fighting? And to me, I think you have to look at the wage market there, and that's sending you a signal that trend core inflation is something like 4.5%. So hiking to 5%, which, Lisa, is already in the price, should be sufficient to cool that type of inflation, assuming you can keep inflation expectations anchored.
And Samir, and I want to build on that just coming up later this hour, but Samir, from your perspective, does this feel plausible, a 7% sort of bear case that could actually not be that unrealistic?
We don't think so. We think it's more theoretical than anything. I mean, come on, there's going to be a lot of damage on the way to 7%, and unfortunately the Fed's just not going to be able to stick to it. So I take nothing away from the theory. But, you know, we've tried average inflation targeting. We've tried things like modern monetary policy theory over the last few years. You know, there's just been so much that we've tried. This may yet be another experiment. But, you know, when you think as a pragmatist, to Tom's point, inflation is coming down. When you look at market-based expectations, you know, those are fairly low. Even the University of Michigan, right? I mean, you're only talking about 2.9 to 3% for consumers in terms of what they're expecting. So again, you just don't need a 7%, you know, Fed funds in that type of environment going forward.
We're going to build on this. Tom Kennedy, Samir Samana, both of you are sticking with us. Let's get a look at some of the stocks moving ahead of the opening bell. Abigail Doolittle has those. Abby.
Hey, Lisa. Well, we do, of course, have the major indexes down more than 1%. But before going at taking a look at what's dragging, let's look at what's working. And that, of course, are some of the retail stores. So the mixed signals that we have in retail continue. Macy's up 7.5%. They put in a monster beat, 52 cents, more than double the estimate of 19 cents. It seems that the company's been able to lure customers. And even with the slowing discretionary spending that we've seen out of other notable retailers such as Target, Bath & Body Works up 17.4%. A similar story, a huge beat. They boosted their profit outlook as well. It seems as though a good mix of products, new and old, is really helping out that retailer. there. As for what is weighing this morning and creating those big losses for the major averages, Apple down 1.8%. This, of course, as yields are higher on this hawkish Fed speak out there, really making tech look more expensive, less attractive. Alibaba down 2.5%, not just on the rising yields, but they also put up a disappointing quarter, missing revenues. JP Morgan Chase, this is the conundrum of the year, Lisa. We, of course, have yields higher, but that's not helping out banks, and oil is lower, and that is weighing on ExxonMobil. So overall, right now, we are looking at a down day. In fact, 2 down days, perhaps the worst since the beginning of November.
Thank you so much, Abby. Banks really interesting in the face of a deeply inverted yield curve. Coming up, the UK unveiling billions in tax increases and spending cuts.
Today, we deliver a plan to tackle the cost of living crisis and rebuild our economy. A consolidation of £55 billion means inflation and interest rates end up significantly lower. We achieve this, Mr. Speaker, in a balanced way.
That conversation coming up next. We do see futures lower as investors parse through some Fed speak, 1.3% decline on the S&P. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Today, we deliver a plan to tackle the cost of living crisis and rebuild our economy. The first difficult decision I take on tax is to reduce the threshold at which the 45p rate becomes payable from £150,000 to £125,140. We will increase the energy profits levy from 25 to 35%, with just under half of the £55 billion consolidation coming from tax and just over half from spending. This is a balanced plan for stability.
Operation regaining fiscal credibility by the UK government. Chancellor Jeremy Hunt unveiling billions in spending cuts and tax increases with inflation hitting 41-year highs. In the US, a split Congress forming a policy gridlock in a lame duck session.
It is official. One-party Democrat rule in Washington is finished.
I have a plea for the Republicans and advice. If you embrace MAGA, you're going to keep losing.
We will use the power of the purse. The size of our debt has got to stop.
We're not going to have to get everything we want. They're not going to get everything they want.
You've got to make an economy that's strong. They're hurting because of inflation.
When we come back in January, hopefully after a productive lame duck session, we welcome you to work with us on a bipartisan basis to get things done for the American people.
Our team coverage on both sides of the Atlantic starts right now. Guy Johnson in London, Emily Wilkins in Washington. Guy, just how austere was this fiscal austerity that we heard today in the autumnal release?
Lisa, we got pretty much what the market expected, but I don't think that disguises the brutality of what we're getting here. This is a £55 billion fiscal consolidation into an economy that is already in recession. The Chancellor talked about that today. It is absolutely brutal. The question is, does it go too far? You talked about the need to regain fiscal credibility following Kwasi Kwarteng's mini-budget. Yes, that certainly needed to be achieved, but does that go, does what we saw today go above and beyond? We are going to see a 7% fall in real incomes in the UK over the next 2 years. We're going back to 2013 levels on that. This is going to be absolutely brutal for the UK. I heard one commentator talking about this earlier, talking about 2 years of hell. It is going to be a very difficult time for the UK. Yes, credibility needed to be restored. Yes, inflation needs to come down. But does this go too far? Will this hit growth too hard? And ultimately, will the market have a problem with that, Lisa?
Arguably, the UK is ahead of the US in terms of when the recession starts. Emily, from the US vantage point, what does fiscal austerity look like with gridlock in DC?
Well, at this point with gridlock in D.C., it's going to be a lot of looking at the Biden administration to see any sort of action occur through executive actions or what the president can do, because we're just not expecting that much from Congress in the next 2 years now. Now, of course, Congress does have some must-pass spending bills. They have to fund the government. They have to raise that debt limit. But those are going to become much more difficult battles now that you are seeing a very narrow majority for Republicans in the House. It means that only a handful of members can really stymie the process unless, of course, they can get Democrats on board. And so expect the next 2 years to be very interesting ones, but perhaps not the most productive from a standpoint of the number of bills passed and the number of major pieces of legislation enacted.
Emily Wilkins in Washington, D.C., Guy Johnson in London, both of you, thank you. The prospect of not getting things done looms large for a market that is heading into recession by many accounts, and this raises some concerns for a lot of people about what the counterbalance will be to said downturn and what that means. Still with us, Samir Samana, as well as Tom Kennedy of JP Morgan, Samir Samana of Wells Fargo. Samir, I want to start with you in terms of what you expect the consequences to be of the lack of fiscal response to any downturn. Has that been thought through some of the stock valuations?
Probably not. You know, I mean, that's one of the things that we've been saying for some time is that even though you've seen re-rating in multiples for a lot of equities, you probably haven't seen a full realization of how much earnings will fall next year. I mean, consensus still sits somewhere between 220 and 230 for the S&P. We're at around 205, and we think that's the next shoe to drop for markets.
What about you, Tom? How do you factor that in, especially as you talk about rates that perhaps are not yet restrictive and could be a lot more restrictive than we think now?
I think when you look at what's happening in Europe and the UK is an especially important cautionary tale for what's happening in America. The UK is experiencing a terms of trade shock like nothing we've seen in many decades. The UK imports more than it exports, and it imports mostly energy and food, and it has a fiscal deficit that needs to be funded by external folks. This is an unfortunate reality of this situation where when inflation spikes, you need to delever and cause more pain. I like your point, though, Lisa. What is in the price is what's most important. The cleanest cut I can see, and Samir, maybe you want to comment on this too, when I look at European equities in aggregate, they trade at about a 30% discount to the US. And that's about the same discount you saw during the great financial crisis. The next question for folks like myself, Samir, is that enough in this scenario? And Samir, I'm really with you here. I don't think it's enough. With the type of shock that we may see, if you need to turn energy off from the industrial sector and reallocate towards citizens just to heat their homes, there's potentially a more painful economic outlook than what's in the price.
For Europe, you're saying, in particular, Tom, right?
Correct.
And so,
Correct, yes.
Samir,
yes.
you want to weigh in?
Yeah, no, I would agree with Tom. I mean, it's just structural issues, right? These aren't cyclical, headwinds. These are structural issues. Whether it's Japan, whether it's the UK, whether it's Europe, they're less energy independent, and so yeah, to Tom's point, they're kind of at the whims of energy markets. And I think one of the big themes probably for the coming decades is trying to secure energy supplies, so that you can have industry not kind of on the whims of geopolitics. And I think that's going to be one of those things that, to Tom's point, probably keeps those multiples a lot lower than people anticipate. So it's cheap, but it's probably cheap for a reason.
Tom, before we let you go, or both of you go, I have to double bet down on that 7% figure of where the Fed funds rate could theoretically go. What probability do you assign us getting to that level at this point?
15%. We do not assign it's similar to what Samir was saying before. This is a possibility, but it's predicated on an event that is behavioral and nearly impossible to model. When I look at what's in the price, Lisa, I think the Fed is slowing the pace of rate hikes. Maybe they're concerned on the margin about financial stability, but in reality, I think they're slowing the pace because they're getting close to where they want to be, and they think that's the level that will be sufficient to cause growth to come down and to actually get inflation down to the level where they'd like to be. Again, I anchor onto the wage growth implications for inflation relative to where the Fed funds rate would be. And in that dynamic, Lisa, what's in the price is enough to cause a recession. I actually feel to avoid a recession, the Fed will have to back off much quicker than what's in the price.
All right, well, there's a lot to extrapolate, and hopefully we can in the weeks and months to come. Tom Kennedy and Samir Samana, thank you both of you for some really incredible talking points and just thought-provoking issues here. Coming up, the morning calls. Later, BlackRock's Kate Moore seeing more room for earnings expectations to come down. More on that around the opening bell. I'm sorry I can't provide more optimism, but that is the state of where we are in the commentary and where we are in markets with S&P futures lower by 1.3%. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Countdown to the Open. I'm Lisa Abramos in for Jonathan Farrow. We started the day without direction. We have found direction. It is down. We're seeing the S&P down 1.4%. The NASDAQ down even more. Why? We are looking to the bond market. We are looking to Fed speak. We heard from Jim Bullard calling for possibly a Fed funds rate of 5 to 7%, saying that rates were not yet restrictive. And what we're seeing is that yield curve inversion continuing. 67 basis points of inversion. Really interesting to take a look at how people are gaming out a recession in the future. Time now for our morning call to look at some of the analyst recommendations on Wall Street this morning. First up, Credit Suisse hitting Norwegian Cruise with a double downgrade, cutting shares to outperform due to downside risk to earnings estimates. Next up, Citigroup downgrading Advanced Auto Parts to neutral, seeing a little upside with a lack of catalysts ahead. And finally, Deutsche Bank downgrading Target to hold, expecting higher prices to continue weighing on margins. Coming up, revenue misses receiving outsized reaction in markets. We're speaking with BlackRock's Kate Moore. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Just moments away from the opening bell. It is a soggy morning. We're trunching some of the gains that we saw last week. We'd see S&P down by 1.3%, 339.16. The NASDAQ down more because this is a yield-driven story. We are seeing yields higher after some jawboning by Federal Reserve officials really talking about the need to go further. We're not restrictive enough. Those were the words of Jim Bullard of the St. Louis Federal Reserve. That 10-year yield up 3.7657 is where we are right now in terms of that 10-year yield. The 2-year yield up much more. And you are seeing dollar strength come back in, 103.27 on the euro dollar. Crude a little bit lower, perhaps the prospect of recession going forward in the face of some of the rate hikes that might need to be expected. Retail earnings continue to roll in. Macy's boosting its outlook. Let's bring in Abigail Doolittle for more. It's been a motley picture out there for retail. Abby,
Well, it really has been, Lisa. Lots of mixed signals for sure. And Macy's and Bath & Body Works really adding to the picture. Starting out with Bath & Body Works, the stock absolutely soaring up about 20%. Now, on the year, it's down in a big way. There's a short interest of 7% on this stock in Macy's. So it could be a little bit of a short squeeze, but the results were actually also good. They put out a big earnings beat. They also raised the outlook. Apparently, their new and old products, along with holiday packages, are doing quite well. Macy's, a similar picture. Their 52 cents in earnings was a big beat over the estimate of 19 cents, and they raised the profit outlook. Apparently, they were able to really bring customers in despite the slowing discretionary. Jeff Gannett, the CEO, talking about fresh inventory being the key, so they're not having those inventory problems. And they are saying, they are acknowledging, of course, that the consumer is under pressure and that they have choices to spend. Well, apparently right now they are spending at Macy's. But as I was mentioning, and as you were alluding to too, not even having to do with the fact that some companies are doing well with retail, others not doing so well. This year, an incredibly difficult year for many of these retailers. Macy's and Kohl's, by the way, they withdrew their profit outlook, and the Gap reports tonight down 50% on the year. What will they bring over the last year, I should say? We don't know, Lisa. Just very difficult to predict this picture. Lots of uncertainty.
Abigail, thank you. A story of those that are really bad and those that are less bad. Earnings separating the haves and the have-nots on a wide variety of different industries. Companies delivering mixed results with only a handful skirting the pain from tighter Fed policy. JP Morgan's Oksana Aronov weighing in.
There are significant lags to Fed policy, lags as long as 12 to 18 months. And so we won't really see the full effect of this tightening probably until, possibly even the midpoint of next year. And so this past quarter was really the first time that we saw inklings of the Fed's tightening have an impact on earnings. Of course, Target most prominently coming out with a pretty dreadful report, right? And so we're going to continue to see that.
Bloomberg's Kaylee Lyons joining us now for more. Kaylee.
Well, Lisa, it's so interesting to see how companies have been treated depending on whether or not they beat or missed expectations. Even a company like BJ's this morning, which posted a beat and raised quarter, while it looked at one point set to open at a record high, it is now actually down by more than 6% on the day. So it just goes to show you the treatment of this market as they try and parse through every little detail that these retailers are putting out, because as Abigail was just talking about, it's been a very mixed week. When you look at earnings season overall, about 70% of S&P 500 companies have topped estimates. So a lot have been better than feared, but look at the sector breakdown of that. 81% of energy companies beating expectations. For hardcore technology, the information technology index, it's around 78%. So think the likes of NVIDIA and Cisco, with both topped expectations with their results after the bell yesterday. But then go further down the pile, discretionary, where a lot of those retail names live, only 59% have topped expectations. And it's even worse for communication. Think Meta and Alphabet. Advertising reliant businesses, where when discretionary ad spending is getting a pullback in this macro environment, a lot of those companies have suffered. Therefore, 45% of them have not come in above what analysts expected. And when you don't do that, when you miss, the punishment has been brutal in this third quarter earnings season. When you look at the average change for S&P 5 companies that have missed expectations, they fall 4.3% after earnings. That is the worst punishment received on average in at least 2 years, Lisa.
Kaylee, just shocking to see just how much things are moving. The lack of certainty really highlighted by some of those shifts. BlackRock's Kate Moore keeping cash levels high and risk low, writing, quote, "We expect a softening economy, higher policy rates, and heightened geopolitical risk to cap upside on risk assets and are not yet adding to our equity allocation." We noted some cracks in management confidence as companies across industries offered weaker guidance. Overall, we think forward numbers still have room to come down. Kate Moore joining us now. I'm so pleased to say, Kate, always wonderful to get your perspectives. So what's your takeaway from this earnings season? How much are we seeing certain sectors be a bit more realistic about the outlook ahead, or is just there no outlook to be had?
Yeah, I think that's a great question, Lisa. And I think Kaylee's points around the really negative reaction to some of the companies that didn't quite beat expectations. But I would also say there's expectations, the published stuff that comes out from sort of sell-side analysts, and the whisper numbers from the buy side, which in some cases were a little bit higher. I also think positioning has played a really big part in how stocks have reacted to the third quarter reports and to what seems to be very tepid guidance for 2023. If these were well-loved stocks or places that, investors were hiding in a much more uncertain macro and market environment, and they didn't quite meet their heightened expectations, they were sold, in some cases taking profits, in some cases just overall risk management. So I think, the sentiment, the positioning played a big part in the stock reaction. And I think that's going to be really in play through the next couple months and as we report fourth quarter in the beginning of next year and get firmer guidance numbers for full year 2023.
And we're seeing that divergence not only across industries, but within the industries themselves. Wedbush's Dan Ives expecting a greater divergence among winners and losers of the earnings season. He's writing, while the clock has struck midnight on hypergrowth in the tech industry and multiples reflect that accordingly, we believe this period of time will further differentiate the winners from the losers in the tech arms race as we enter 2023. Is that what we're seeing? A differentiation, Kate, the winners, the losers, perhaps the obsolescence of Meta and still the dominance of Apple? Or is this something more wholesale about how much money was poured into a tech space as money was basically free?
Yeah, I think there's an enormous range of balance sheet, revenue opportunities, management within the sort of the tech space. And it's really hard to look at it like a monolith. On one hand, you obviously have some of these companies more in the communication side, but generally in the tech space that have really been dependent on advertising. And as you mentioned before, we've seen some decline in terms of overall advertising spend. On the other side, you see companies perhaps in the software space, many of whom have solid revenue prospects for 2023, who've given pretty good guidance, but were trading at extreme premium multiples at the beginning of this year, who have derated. And while the fundamentals look okay, I don't think investors are willing to jump in wholesale at this point until they have a sense for where the terminal rate is going to be and what the overall impact on multiples will be. So you have this really interesting and really complex environment for the technology space, where some of it is around the macro and kind of slowdown in demand. Some of the fundamentals look good, but still a lot of rate sensitivity, making it really hard, even though there is differentiation in the fundamentals, to say that, different parts of tech can meaningfully outperform or really break free.
Or lead in the next cycle, and whatever cycle that may be. What will lead from your perspective?
We kind of prefer a barbelled approach in the portfolio right now. I will just tell you our overall equity risk is low relative to where it has been historically. We've kept our risk low throughout the course of 2022. That's been a smart thing for us to do, and we've been using options and derivatives pretty aggressively, actually, to play the market more tactically. But when it comes to sectors, and I look out over the next year, I see two really interesting areas. One, I think there's still prospect for upside for the resource space, and that's energy and parts of materials, either on a China reopening or actually on a very strong supply-demand balance and strong capital discipline from many of these resource companies. So, those are kind of more cyclical companies historically, but actually have strong fundamentals that we think can do well, even in a more moderate growth or a lower growth environment. And then the other side is, I do think we're going to get to a place at some point in early 2023 where we have a sense for the terminal rate, where multiples have come down enough, and where there's enough proof in the pudding when it comes to software and actually even parts of semis that the forward growth prospects are going to be solid. And so we like some to kind of nibble a little bit in some of those areas, some of those industries within technology.
What about retail? And I realize, Kate, that this has been sort of a dirty word for a long time, and the pain has been pretty vast, and people could say that if there was any bubble, it has been burst and then burst again and then taken a pitchfork and thrown through it. So at what point do you start to see value in certain names that are emerging as the behemoths? I'm thinking of Walmart doing well, Macy's doing well, Target not, and how much this really is a management selection at a time when you do have already a lot of pain baked in.
Yeah, it's a great point, Lisa. I mean, retail, as just like the technology, is a pretty mixed bag. Companies who've managed their inventories well, who've managed their overall overhead well, maybe it's their real estate costs, et cetera, and those that are kind of struggling. The challenge is, we were in a structural decline in terms of overall retail. We talk about it as bricks and mortar retail before the pandemic. And then there was, of course, the cratering as everyone purchased things online. And then there was, heightened expectations that some of the return to regular stores would pick up. But we need to remember we are in a sort of changing consumer behavior environment, a secular trend that's going to make it harder and harder for traditional retail to perform in the way it might have done in the teens. So I think you really have to pick your specific names here. I think you have to pay a lot of close attention to how companies are talking about inventory management, how they're pivoting for consumer desires, The one thing I will say, despite kind of concern around investing in the sector, we feel pretty good about the health of the consumer in general. Wages continue to grow. Balance sheets still look healthy to us. And we weren't that surprised by the retail sales number that came out just a few days ago.
Kate, I want to talk about that because the strength of the consumer is the bane of the Fed's existence right now because they'd like to see a little bit less so that we can get closer to their goal. We heard Jim Bullard earlier this morning from the St. Louis Fed talking about how we're not yet restrictive, talking about the prospect of a 5 to 7% Fed funds rate if inflation keeps up. He keeps talking, though, and he does say that he expects that rapid disinflation will take hold once the process takes effect. How concerned are you about more persistent inflation that, yes, we might get down to 5% quickly, but not necessarily to 3 and 2% that quickly, causing something that forces the Fed to go beyond where markets can tolerate, to something that causes financial accidents that the Fed is not willing to address because of their immediacy, because of the concern about inflation?
Lisa, there's so many questions and so much to kind of unpack there. Let me start kind of where our rate expectations are. We're looking for another 100 basis points of rate hikes at this point, but I think the risk is skewed to the upside here. Basically, on both stronger economic activity and, frankly, strong consumer activity, leading to persistently high inflation. So while we are looking for, an end at some point in early 2023, or at least a pause to this part of the rate hiking cycle, I think the question you pose about the economy staying strong enough and inflation staying sticky enough that the Fed needs to think about re-engaging at another point, I think that's a good question and something that we're going to really have to probe. Right now, there's not enough information for us to say definitively that that's the course. And so that's one of the reasons why we've kept our overall risk in the portfolio more moderate. And we're being, I think, more conservative because it's very difficult to identify the exact regime that we're in or the end of this sort of rate hiking cycle.
Kate Moore, brilliant as always. Thank you so much for being with us.
Thanks,
Kate Moore
Lisa.
of BlackRock. Coming up, PIMCO is seeing the tide turning for bonds, predicting a rally if recession hits next year. We'll discuss that with Aaron Brown.
The NEC was started under President Clinton, and Bob Rubin was the first person to hold that job. Can you explain to people what it actually does and what the NEC does day to day? For example, who's in the NEC, who's on the NEC, what is your job actually to do?
So the National Economic Council, the job, the mandate, the mission of the organization is to coordinate economic policy across the executive branch and across the cabinet to make sure that the president is getting the benefit of when making decisions of his entire economic cabinet, and also that the economic cabinet is getting clear direction from the president as well. So that two ways. So it's a coordination function. On the NEC itself are all of the relevant cabinet members, the sort of core economic team, OMB, Council of Economic Advisors, Treasury, but also Secretary of Labor, Secretary of Commerce. My team, the NEC team, is a small team within the White House that is, our job is to do that coordination across the range of economic policy.
Now, you were the deputy in the Obama administration at the NEC, now you're the director. Which NEC worked better, the Obama administration one or the Biden one?
Well, on the issues that I worked on in the Obama administration, it worked very, very well. And the current NEC works very well as well.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
Prices received data by manufacturing firms in the Philadelphia region, which, like in the New York region, went up to 34 and change from about 31. So we're far from having defeated inflation at this point.
John Roddick speaking as we get a busy day of economic data in America. Housing starts, building permits, the Philly Fed Index, and initial jobless claims all came out this morning. Claims unexpectedly retreating. Not necessarily a good news for a Federal Reserve, where they are looking at a labor market that is still too strong for their liking. Bloomberg's Michael McKee is back with us to discuss. Mike, what is the takeaway from today's data so far?
Well, it's all kind of around the margins, and it doesn't give any one side winning argument. Obviously, John Roddick is on the side of the Fed needs to do a lot more. This is what we're looking at. Housing starts and building permits both down, but we knew that basically because the housing market has really cratered since the Fed started raising interest rates. Philly Fed was interesting. They really slowed down. This third consecutive month that the Philly Fed Index, business index, has fallen, and there is obviously pessimism among Philadelphia area manufacturers about the outlook for the economy going forward. You mentioned the jobless claims numbers. Kind of what's significant about that is that this was the week that they take the payroll survey. So the fact that they went down would be 1 point in favor of a reasonably good November payroll number. Now, as to John Roddick's arguments about the Philly Fed and the prices received versus prices paid, you can see the blue there is prices received, and that has been going up. Companies are paying less for their inputs, but they are still charging a bit more. And until that dynamic changes, we're still going to be having some inflation problems, and that is what Jim Bullard is talking about. Jobless claims, you can see here, the bottom line is kind of is where claims are. The top line is continuing claims, and that's the one that we want to watch. It's looking at where jobless claims are for people who are still getting claims, not just the initial claims, and they're still somewhat higher. So we're looking at maybe people not finding jobs as quickly as possible. By the way, Lisa, I have an update on Jim Bullard. He says that his minimum for the Fed funds rate is 5 to 5.25%. The 7% is under a worst-case scenario, and he did say that he expects inflation to start to go down quickly once it does start to go down.
Michael McKee, thank you. And Tom Kennedy of JP Morgan talking also about how a 7% type of rate would only be in a worst case scenario. He assigns it about a 15% probability. PIMCO's Aaron Brown making the case for bonds amid the worst performance year on record, writing, quote, with interest rates higher amid a challenging macro environment, we see a compelling case for bond allocations. As a recession begins and inflation slows, duration is likely the first asset class to be poised for outperformance. I am so pleased to say that Aaron Brown joins us right now. Aaron, thank you for being with us. Always a pleasure to get your viewpoint. This has been one of the key issues. We talk about the Treasury, the longer-term Treasury curve rallying. You see 10 years, 30 years rallying, which is not what the Fed wants to see. So how much can you lean into that trade when that eases financial conditions and causes the Fed to go harder on the front end?
I think that exactly is the conundrum that the Fed is facing and will continue to face over the next couple of months. They don't want financial conditions to ease as they move to a slower pace of rate hikes and eventually a pause. And that sort of the cross-section between higher rates and the Fed sort of indicating that they don't want that financial conditions to ease is going to create a little bit of a pickle, because the more that we see financial conditions ease, the higher that the Fed is going to ultimately have to move rates. And so they need to really navigate their language in terms of indicating that they're moving to a slower pace because that's what the economy needs right now. But by no means do they think that this is, off to the races in terms of moving towards a rate cut. Right now, keep in mind that the forward curve for interest rates is pricing in about 2.5 rate cuts next year. It's been a significant and dramatic repricing since the last CPI print. I think that that's overly aggressive versus what the Fed is ultimately going to deliver.
And that's what basically the Fed has been saying repeatedly. No, you guys are wrong. We are not going to be cutting rates because we are concerned about how sticky this inflation is. When you take a look at how bonds and stocks have been correlated, with bonds yields going down and stocks rallying and bond yields going up and stocks selling off, when does that break down, right? When do we start to see something where lower yields on the long end is bad news and comes in tandem with a real risk-off feel? That's what seems to be what you're talking about.
It's exactly what I'm talking about. In every single recession that we've had over the last 40, 50 years, we've seen stocks and bonds negatively correlated as we move deep into the recession. When you're in a late cycle environment, which arguably we've been in over the last year or so, typically you actually see bonds perform poorly as you move later cycle. The market starts anticipating Fed hikes, bonds start to sell off, and equities also can sell off in tandem. But as you move through a recession and deeper into a recession, that's when bonds start to outperform. I think that there's two necessary conditions that need to be met before we start to see that negative stock-bond correlation resume. We're probably approaching that over the next month or two. The first is really see a firm crest in inflation and start to see inflation start to move lower. We've had one print on this side, the most recent print, but we need to see a couple of more inflation prints to really give credence to the view that inflation truly has peaked. The second is that we need to see bond market volatility start to subside, and probably related to that, we also need to see the Fed start to slow their pace of rate hikes. So we're getting to that point where I think you'll start to see more of those traditional stock bond correlation benefits start to help portfolios. But we're not, we haven't certainly firmly and credibly approached that yet. And so we're really waiting for those two catalysts.
This might be a good year, 2023, for the long end of the Treasury curve. But what about credit? I mean, perhaps investment grade, I understand. But riskier credit, it's held in there. Why will that do well, too?
So I think you really need to separate credit between those that are remote default risk and those that are closer to potential default risk, have a higher probability of default. I think those companies or those credits that are high quality, that are investment grade, and that have good free cash flow generation, don't have over leveraged balance sheets, and can operate in an environment where nominal GDP growth is not exceptionally strong and potentially even negative. I think those sort of high quality corporates will do well over the next 12 months or so. You've seen significant spread widening year to date. These companies are trading at good relative valuations versus equities, and so I think that's where you want to park your bets. I would stay away from high yield.
Erin Brown, thank you so much, as always. Coming up, the market-moving events you need to be watching. That's next in our Trading Diary. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Time now for the Trading Diary. We need to be watching through the next week. The Fed speak continues. Jefferson, Kashkari, Evans, all on deck. President Collins speaking on Friday, then Mester, Bullard, and George all coming up next Tuesday. And finally, the Fed minutes coming out on Wednesday. From New York, this was Countdown to the Open. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Innovation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sci-Fi stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145. and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010, after staying for almost 1 year in the hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
the threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about. This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter. It's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for